Hi students, my name is Adil Shafiq. So today we are going to make a quick revision on the MA topics that you had studied earlier, right? So we will be starting with the accounting for management basics, then we will be covering accounting for material, then labor, then overheads, and some of the standard costing, budgeting, and other concept. So the purpose of this is to brush up the things that you had been studied in the regular MA classes, all right? So let's start with accounting for management. Okay, so it's just the basic thing we are discussing about what data is and their definition. All right, so what is data? So data is nothing but it consists of numbers, letters, symbols, raw facts, and events and transaction, which is recorded but not yet processed. Okay, so data is something that we are getting. All right, and based on data, we'll be processing it and we'll be generating informations. Right. So that what information means. Information is data which has been processed in such a way that it is meaningful to the person who receives it. Okay, so data itself does not have no real meaning. All right, data itself have no meaning, right? Data itself does not have any meaning. It's the information. Information is something that gives value to the data. Information is something that gives value to data. All right, and so in order to make a good information, our data should be in a form that we can make it more good, right? So in order to make a good information, all right, that by processing data, in order to make it a good information, it should be accurate. It means the information we are generating from the data, it should be accurate and it should be complete. All right, so there shouldn't be any bias on the information that we are generating, and it should be cost effective. It's based on the cost benefit analysis, right? Cost versus benefit analysis. All right, so comparing the cost, the information should be effective to the company. All right, or it will give value to the company, and the main thing, the information should be understandable. All right, so the person who receives the information should know that what is meant by this information. All right, so the increased use of jargons and some other things may decrease the value of information that we are generating. All right, so the way of communication is also important. So it should be understandable and it should be relevant. The information we are generating, it should be relevant for the reason that we had obtained the data. All right, so we are obtaining data for any of those reasons, for making some decisions. All right, so for such decisions we will be generating information. So such information should be relevant to the purpose. All right, and next is as accessible. It means that the person who wants that information should have access to that. Okay, so the person who are seeking those information should be provided the access to that information, so that they can give, so that they can use that information and make ideas on it, right? And then it should be timely. Okay, it is a very important thing. All right, so when we will be studying the topics, it will be before the exam. So after the exam, if you study, is there any use? No, that's the same thing. The information should be generated at the time they are needed. Okay, not after the required time. And next is easy to use. All right, free flow of resources. It means the information should be so easy to use that everyone can use it according to their requirement and purpose. All right, so these are just the attributes of good information. All right, and the main use of this information is to plan. Okay, is to plan something. And for a multinational company, there are three levels of planning stages. All right, the first level of planning will be the strategic planning. All right, strategic planning, and strategic planning is the long term planning of the organization. Okay, it means that how the company should be in next 5 years or next 10 years. It represents the future of the company, the future aspect of the company, the future plans of the company. Okay, in 2030 we should be at this level. All right, so these are the plannings made at the strategic level. And in order to achieve those strategic plans, there should be a breakdown of plans in order to execute that, and that's where tactical planning becomes relevant. Okay, in tactical planning, it takes strategic plan and breaks down into parts to achieve the strategic plan. All right, so if my company is planning to start a branch in, let's say, UAE in the next 5 years, that's a strategic plan. And in order to execute that, we should look for the warehouse, the office, the employees, and all. It's a it's a part of tactical planning. All right. So my strategic plan is to build a building, or like start a company in other country. Okay. So that's a strategic planning, and the tactical planning is that the things which are required to execute that should be break down into pieces, and each person should be given the responsibility to make that possible. That's where the tactical planning means. And operational planning is the day-to-day decisions in the organization. All right. So if my company had started working, there will be employees, supervisors, managers. So each day, okay, each day how the company should operate, okay, how much production should they make, how much sales should they make, it's a part of operational planning. It's a day-to-day decision of the organization. All right. And next is a based on responsibility accounting. So this responsibility accounting is mainly used to give the managers on what they are responsible for, or the supervisors or the CEOs, or like to know that what they are responsible for. That's what responsibility accounting means. Okay, each person will be given a responsibility and some freedom to execute things in their own way. And in order to check whether they had executed it in an effective way, we will use responsibility accounting. So it is based on identifying, okay, it is based on identifying individual parts of the business. All right. It is mainly based on identifying individual parts of a business which are responsibility of a single manager. So in responsibility accounting, the manager who is responsible for such action will be made responsible for that, and he will be rewarded if he achieve the if he achieve his responsibility to the budgeted level. All right, above the budgeted level. That's what happens. So there are 4 types of responsibility centers. All right, the first type is the cost center, then revenue center, then profit center, then investment center. Okay, so in cost center, it incurs only cost but no revenue generated. Let's say production department. Okay, in production department only the production is taking place. All right, so the production manager can be made responsible for the cost center, right? But they are not incurring any revenue. All right, the production department will produce the item and they are given to the sales, and it is a sales department who is selling and getting the revenue. Production department itself is not generating any revenue on their own. They are only incurring cost. All right, and the next is revenue center. It's like the example of revenue center itself is the sales department, because the sales department is itself is not incurring any cost for the production. All right, they are only selling the item that they are given to by the production department. That's it. And in profit center, all right, in case of profit center, like let's consider a branch. All right, a branch can be considered as a profit center to some extent, because the branch will be doing sales and production, right? A branch will be performing sales and production. So this can be considered as a profit center because they have both cost and revenues, right? So let's say like the manager of a division or the manager of a branch can be considered as a profit center. But if the manager also has right to investment, it means that if that branch, okay, if the building that they are working on need to be like, let's say like restructured, or like any refurbishment is required, and the manager have access to that, then that is not profit center. It can be considered as investment center only. Because if a manager have access to the profit and the investment, all right, profit is made from the investment that you are making, right? If you are like giving a good building or like good warehouse, all right, the production may increase and the profit may increase. So if a manager is having access to the assets which help to generate this profit, it can be considered as an investment center. All right, so you got the difference between hope you got the difference between profit center and investment center. In profit center, the manager is only responsible for the profit, not for the assets that is generating the profit. But in investment center, he will be responsible for the profits and also the assets which are used to generate generate those profits, right? So these are the 4 main types of responsibility centers. It's nothing but cost center, revenue center, profit center, and then at last it's investment center. All right, so this is the basic thing to know about the accounting for management. That's it. All right, so next we will be looking at the cost classification. All right, as you know that management accounting is a paper which is mainly based on the internal management of the company. So we will be mainly focusing on how the company should internally operate, what the company should do in order to generate more profit, what investments to make. That's it. Okay, it's not so related to financial accounting, right? So in financial accounting, we know that like we will be having certain standards such as IAS and IFRS, how to prepare financial statement, how to prepare profit statement, how to prepare SOFP, the cash flows and all. But in management accounting, there is no such standards. All right. So the management accounting paper is like very flexible because it's based on the internal management of the company. All right. So here we are not studying about any standards. Here we are studying about the measures that we can use to make the company's internal management to the next level. All right. So next we will be looking at the cost classification. All right. Next we're looking at the cost classification. So in cost classification also we has like different types of cost items. All right. So the first is cost object. Okay. So the cost object is any activity for which a separate measurement of cost is undertaken. It means that we can separately measure the cost required for the item. It's a cost object. And the example can be considered as the cost required for furnishing a room. All right. The cost, let's say the cost required for furnishing a room. All right. Let's say all right. So the cost required for furnishing a room can be considered as one of the cost object. All right. Cost for furnishing cost required for furnishing a room. All right. The cost required for furnishing a room can be considered as a cost object because if we had finished furnishing that entire room, we can know that how much cost is incurred. Okay, so maybe I put some sofas to the room, then I can measure the cost of the sofa. Then I may paint the room, I can measure the cost incurred for the paint. That's how, if we can measure the separate cost incurred for an activity, then it can be classified as a cost object. All right, so it can be cost of a product or the cost of a service. All right, it can be either of those. Okay, like the cost incurred for a production of a product or the cost incurred for a service to be provided. All right, so that's what cost object means. A separate measurement of cost can be done. That's it. And the next is cost unit. Okay, cost unit means if we can get the cost of each unit, right? Unit of a product or service in relation to which costs are certain. It means that one. All right, so the one cost incurred. All right, let's say, so the cost object can be considered as a production of, let's say an example of production of pencil. All right, so the production of pencil can be considered as a cost object. So the whole cost incurred for the production of pencil can be considered as a cost object. And the cost unit is that the cost incurred for each of the pencil. The cost incurred for each of the pencil can be considered as the cost unit. Okay, so it's a unit of a product or service to which costs are ascertained. And the like other example is that a room or a box of steels. Okay, so like if you had produced 10 rooms, or like if you are building an apartment, it's a cost object. It's a whole is incurring a cost, and the cost unit is that the each unit on that apartment, means each room. That's the cost unit. And next is cost centers. Cost centers is like, it's like production or service location, function, activity, or an item of equipment of which costs are ascertained. It can be a cost center, right? It can be a department or a machine. Okay, so for that, if the cost is happening, all right, so that's what cost center means. All right, so in a place where the cost is incurring. All right, in a place, so it can be a like production, like production department or this machine. All right, if the machine is working, the cost is incurred. It is not considered as a cost object because it is not incurred for the purchase of the machine. It's the machine itself. The machine itself is generating cost for us. All right, or the department, the production department is incurring cost for us. So it is considered as the cost center. So that's what the difference between cost object, cost unit, and cost center means. All right, hope you all get it. And next we are looking is the cost card. Okay, a cost card is something related to the breakdown of cost that is incurred for the product. All right, it is used to show the breakdown of the cost of producing output based on the classification of each cost. All right, so this is the type of cost card. Okay, so I'll give an example of cost card. All right, so this can be considered as a cost card. All right, so let's say it can be a cost card for pencil. All right, for the production of pencil. So in order to produce a pencil, we'll be incurring the material cost. All right, so in cost card of pencil, there will be material cost stated. Okay, so the material cost will be this much amount, and then there can be labor cost. All right, the person who is like making the pencil will be given payment, and this can be labor cost. And then there can be variable overheads, like variable production overhead and fixed production overhead. There can be variable production overhead and fixed production overhead. It means that a cost card is something which includes all the cost that is related to the production of that item. All right, it is used to show the breakdown of the cost of producing output based on the classification of each cost. All right, it includes cost of direct material, direct labor, direct expenses, and also the prime cost. All right, so this like direct material, direct labor, and direct expense is collectively known as the prime cost, and it will also contain the variable production overhead and also the fixed production overhead, and also if any of the non-production overhead. Okay, so let's say let's say selling cost of the product. All right, so the cost incurred for the product in total is included in the cost card as a breakdown, not in total. All right, so if looking at the cost card, like I can get knowledge on how much cost is incurring for the raw material, how much cost is incurring for the labor, how much variable production overhead is required, how much fixed production overhead is allocated to the product. That's it. Okay, and the other basis of classification of cost is it is based on the element. All right, so based on the element, it is like the classification is based on material, labor, and expenses. All right, so this is like another type how we can classify cost. And the next type is based on the nature, whether the cost is direct cost or indirect cost. So the direct cost is also known as the prime cost, right? The direct cost is also known as prime cost, and the indirect cost is known as nothing but overheads. And next classification is based on the function. Okay, so based on the function, it is production cost and non-production cost. Okay, so like the cost which is incurred within the production department would be production cost, and the all other selling cost, distribution cost, and other cost can be considered as non-production cost. And next is based on the behavior, how the cost is, what is the nature of the cost. All right, like is the cost increasing from production or is the cost is constant. So like that also we can classify the cost, and it is like variable cost, fixed cost, then there is step fixed cost, and also semi variable cost. So first let's look at the variable cost. So variable cost is something, the cost that vary in direct proportion with the level of activity. It means that if I produce 1 unit, there will be a cost, and if I produce 2 units, the cost will be double. All right, that's it. And if I produce 4, then it will be like the double of that. That's it. So if the cost is varying with the direct proportion to the level of activity, it is variable cost. It increases with the activity level. All right, so let's say if I'm producing 1 unit, the cost will be $2. So if I'm producing 5 unit, what the cost will be? It will be 2 into 5. It will be how much? $10 will be the cost to produce 5 unit. That's how variable cost work. It increases with the level of activity. For 1 unit, it's $2. For 5 unit, it will be 5 into 2, $10. Okay, so that's how variable cost work. Okay, so this is the graph of the variable cost. So if we are considering the total cost, all right, like let's say we haven't produced any unit. Okay, so if the level of activity is 0, like then the cost will also be 0. If I had produced, let's say 5 unit, then the total cost, it means the variable cost will also increase. So the variable cost will be how much? Let's say like this much will be the variable cost. And then I produce 10 unit, then what will happen? The cost will increase and reaches at this point. Okay, so that's how variable cost work. So the variable cost in total, all right, the variable cost in total increases with the level of activity. If level of activity increases, the variable cost increases. That's how it works. But for each unit, the variable cost will be the same. So that's the second graph. So the cost per unit does not change with the level of activity. So let's say in this example, the variable cost per unit is $2. Even if I produce 10 units, my total cost will be $20, right? If I produce 10 unit, then my total cost will be $20. But still, what will be the cost of one unit? It will still be $2, right? So the cost per unit for variable cost will be same regardless of the level of activity. Even if the level of activity is 1000 also, the cost per unit will be constant. It will be $2 only. That's it. So that is the two types of graph in variable cost type. Okay, so like there is total cost graph, then there is variable like per unit graph. So this is what variable cost means. And then there is fixed cost. So fixed cost is cost which is incurred for an accounting period and remains constant till certain level of activity. So I'll say an example. All right, so let's consider the rent. All right, so assume that the rent of the factory is, let's say, $1000. All right, so the rent that I should pay for the warehouse or the production department is, let's say, this $1000. All right, but so like this is the cost I'm incurring, so I need to recover this cost. So I will be charging this cost to each of the unit I am selling. All right, and assume that the unit that I had produced in that warehouse is, let's say, 100 unit. All right, so 100 units are produced in that. Okay, so that's one situation, and other is I produced 0 unit. Okay, so even if I produce 0 unit in that year, should I pay the rent? Like I produce 0 unit, should I pay the rent? Obviously I should pay the rent, because the landlord is not cared about my production, they are just cared about the rent. So that's what fixed cost means. It will be incurred regardless of the level of activity. Even if the level of activity is 0, or if the level of activity is 1000 or 10,000, still I should pay the rent. The rent should be paid at the start or the end of every month. All right, so if I produce 0 unit, then also I should pay the rent. So assume that I produced 100 units. All right, I produced 100 units. Okay, so in that case I should recover this cost of 1000, right? So what will I be doing? I will be charging this 1000 to each of the 100 unit. How it would be? It would be 1000 divided by 100, right? So it would be $10 per unit, right? It would be $10 per unit. It means that if I produce 100 unit, I will be charging $10 per unit as the rent. I'll be recovering $10 from the each product as the rent. So next situation is, assume that I had produced, let's say, 1000 unit. I had produced 1000 unit in that year. So in that case, how much would be the rent that I would be recovering? It would be $1000 divided by 1000 unit. It would be how much? $1. It means that the fixed cost had been $10 when my production was 100 unit. Okay, and it had reduced it to $1, only $1 if my production was 1000 unit. All right, so in fixed cost, the per unit will decrease as the level of activity increases. Okay, since the level of activity was 0, the cost was 1000 only. I should pay that, and I can charge it to any of the product. And if my production was 100 units, all right, when my production got to 100 units, the fixed cost per unit was $10, right? It was $10. And when it had increased from 100 to 1000 units, then it was only $1. It means that the fixed cost per unit decreases. Fixed cost per unit, all right? The fixed cost per unit decreases as the level of activity increases, and the total cost will remain constant regardless of the level of activity. All right, so it's the opposite to the variable cost concept. All right, so here look, the total cost is same. The total cost is just same. Like let's say it will be $1000 regardless of the level of activity. All right, so even if the level of activity is increased or decreased, or even if the level of activity is 0, still I should pay this $1000 rent. And in case of per unit, all right, so like if my production is 0 also, I should pay what? The rent. All right, so I guess that if my production was 1 unit, I would be allocating this $1000 rent to that 1 unit. So the cost would be $1000. So let's consider like this as $1,000 cost. Okay, and if the level of activity increased, all right, so here the level of activity had become, not here, let's say here the level of activity had become 100 unit. Okay, then the per unit cost had decreased to $10 only. So this can be considered as $10. And I had increased the production to 1000 unit. Okay, so let's say like this is the 1000 unit. Then my cost was only $1, right? So this is, let's say, 1000 unit. Then my cost was only $1. So that's how the cost per unit for fixed cost decreases as the level of activity increases. So here when the level of activity increases, the cost per unit is decreased. That's how the concept of fixed cost work. All right, and so that's what variable cost and fixed cost means. Then we'll be looking at the step fixed cost. So step fixed cost is nothing. Assume that there is a supervisor. All right, there is a supervisor in a company, and the supervisor is paid, let's say, $100, and he'll be looking after how much employees? He'll be looking after 50 employees. All right, so this one supervisor is responsible for looking at 50 employees, and this 100 is obviously a fixed cost because it is his salary. All right, even if he like not work, even if he take leave also, then we should pay the salary, right? So this 100 is a fixed cost. Okay, and he'll be looking at 50 employees, and currently there were only 50 employees also. Okay, but when the 50 employees increased to 51 employees, then this supervisor can't look at them. Then we should be hiring the new supervisor, and for that new supervisor also I should pay the same salary of 100. So till 50 employees the fixed cost was $100 only. When it increased to 51th employee, it will be $200 of fixed cost. That's how step fixed cost work. It is a type of fixed cost that is only fixed within certain level of activity. In here, the certain level of activity is 50 employees. Once the upper limit of an activity is reached, so here the upper limit was 50 employees, then the new higher level of fixed cost will become relevant. Okay, so here our old fixed cost was $100 only. Now the new relevant cost is how much? $200. Now the relevant cost is how much? $200. That's how step fixed cost work. Okay, so in this graph also, at starting it was only 100. So and then it increased to 200, and when the number of employees become 101, then it would be, let's say, 300, 400, and so on. So that's what step fixed cost means. Okay, and next we will be looking at the semi-variable cost. Semi-variable cost is nothing but it contains both fixed and variable cost. All right, the semi-variable cost contains both fixed and variable cost element. All right, so the graph of the semi-variable cost will show the nature of both fixed and variable cost. So let's consider the total cost of fixed cost and variable cost. So the fixed, one second. So let's look the variable cost. All right, in variable cost, the total cost graph was a slope. All right, you can find the same thing in semi-variable cost also. There is a slope here. All right, in total cost of semi-variable cost also there will be a slope, and the total cost of fixed cost, there was this graph. I mean, the cost was starting above the zeroth line, right? The cost was starting above the zeroth line. All right, so here it says that even if the level of activity is 0, there is some amount of fixed cost. The same nature can be seen in here also. It means the variable cost is not starting from 0, it is starting from some other amount. All right, so the semi-variable cost show the nature of both fixed and variable cost. So this is the fixed cost, this part is the fixed cost, and this part is the variable cost. All right, and for per unit also, all right, the variable cost is constant to a certain level. All right. So the variable cost graph was this. So this is the nature of variable cost in case of per unit, and this is the nature of fixed cost per unit. All right. So the graph of semi-variable cost contains both, like the nature of both variable cost and fixed cost, and that's how it works. All right. So that's what semi-variable cost means. It contains both fixed and variable cost elements. That's it. And how can we identify the cost? I mean, if it is said that for 1000, in order to produce 1000 unit, the cost was 10,000. How can I know whether that cost is fixed cost, variable cost, semi-variable, or step fixed? All right. So the fixed cost will be constant in total. All right. It means that in case of 1000 units, the cost was 10,000. Even if I produce 1500 also, if the cost is same 10,000, then we can say that that cost is a fixed cost. It is not changing with the level of activity. Even if the level of activity had increased from 1000 to 1500, the fixed cost was just the same. All right, that's it. And the variable cost is constant per unit. All right, so the variable cost will be constant. So let's say in order to produce 1000 unit, the cost was 10,000 unit, and in order to produce 2000 unit, the cost was 20,000 unit. How much will be the variable cost per unit? 10,000 divided by 1000, it will be $10, right? And 20,000 divided by 2000, it is $10 itself. So this means that this 10,000 is a variable cost and this 20,000 is a variable cost. So the variable cost will be constant per unit. And semi-variable cost is neither constant in total or constant per unit. All right. Since the semi-variable contain the nature of both variable and fixed cost, it won't be constant in per unit or in total. It will change. So in order to separate this, we are using a method called high-low method. All right. So we'll be looking at that. And the next is step fixed cost will be constant in a total within a certain range. Up to a certain level, the step fixed cost will be constant, and then like it will start to increase. All right. So in case of this, like supervisors, like examples such as supervisor salary and all, right? So next we'll be looking at how to use the high-low method. All right. So there are 4 steps to get the high-low method. So in costing, you will be given certain units. All right. So let's say like 1000, 2000, 3000 unit, and the total cost associated with those units. So first you should lead it there. So first you should consider is that select the highest and lowest activity level. All right. The highest and lowest activity level should be taken first. All right. The highest and lowest activity level should be taken first. All right. And after that, calculate the variable cost per unit. All right. Calculate the variable cost per unit. And in order to calculate the variable cost per unit, the equation is cost at highest level of activity minus cost at lowest level of activity. All right. And then divided by highest level of activity minus lowest level of activity. It means that like if we are taking 1000 unit and 2000 unit, and the cost of 1000 unit was 1500 and the cost of 2000 was 3000. So like the equation will be 3000 minus 1500 divided by, let's say, 2000 minus 1000 or 1500 minus 1000. So that's how the equation goes. So the equation will be cost at highest level of activity minus cost at lowest level of activity divided by highest level of activity minus lowest level of activity. That will be the equation to get the variable cost per unit. And after getting the variable cost per unit, we can get the fixed cost. All right. So as you know that this total cost would be containing both variable cost and fixed cost. All right. So, and how we can get the variable cost? The variable cost would be units into variable cost per unit, right? So by multiplying the variable cost per unit into unit, we will be getting the variable cost. All right. So that is the same which is applied here. So here we had got the variable cost per unit. So in order to get the fixed cost, I will be taking either of the total cost. Either it will be 3000 or the 1500. So I'll be taking the total cost and minus variable cost per unit into activity level. All right. This total cost contain both fixed cost and variable cost. All right. And if I deduct the variable cost from it, then I'll be getting the fixed cost. So that's the equation here is. So fixed cost is equal to Total cost at activity level minus variable cost per unit minus the activity level. All right, that's how it works. And after that, if I want to get the total cost at a different level, all right, like here the unit was 1000 and 2000. Let's say I want to get the total cost for 3000 unit. All right, so the total cost will be the fixed cost plus 3000 units, right? 3000 into variable cost per unit. This will give me the total cost. This is how the high-low method works. That's how we can get the total cost incurred for the product. All right. So this is how high-low method works, and it is mainly used if the cost is semi-variable. If it contains both fixed and variable, first we will separate the variable cost by deducting the cost at highest level of activity minus cost at lowest level of activity divided by highest level of activity minus lowest level of activity. And in order to get the fixed cost, we will be doing the total cost minus total variable cost. It will be variable cost per unit into that certain activity level. So that we will be getting the fixed cost and the variable cost per unit. By having this thing, we can get the total cost at any of the activity level. All right. That's how the high-low method works. And if in some cases there would be step fixed cost also. All right. So let's say with an example. So assume that the cost incurred for 1000 units was $15,000 and the cost incurred for 2000 units was, let's say it's 35,000. Okay, so this is the situation. The cost incurred for 1000 unit was 50,000 and the cost incurred for 2000 was 35,000, and it is said that after 1000 unit, all right, not 1000, let's say after 1500 unit, the fixed cost increases by 5000. All right, fixed cost increases by 5000. It means that till 1500 unit, the fixed cost will be an amount. All right, and after 1500 unit, the fixed cost will increase by 5000. It means that this 2000 unit total cost of 35,000 contains a 5,000 which is not included in the 15,000. All right. So in high-low method, the first assumption is that the fixed cost is same at both activity level. All right. Even if the production is 1000 or 2000, the fixed cost will be the same. Okay. So that's the assumption is made in high-low method. But in this case, this 35,000 contains a fixed cost that is not included in this 15,000 cost. So before using high-low method, we should deduct that fixed cost. All right. So before using high-low method, we should deduct that 5,000 from here. So it would be 30,000. So the 30,000 and 15,000 will be used to get the variable cost and fixed cost for this product. All right. That's how it works. So if in question it is said that, so in a question it is said that a stepped amount is made at a higher activity level which is not in the lower activity level, it should be deducted from the total cost before using the high-low method. It means that before using the high-low method, we should deduct that increase in step fixed cost from the highest level of activity so that we can do high-low method. All right. So this is the thing which you should know in the cost classification chapter: the type of cost, the nature of cost, the graph of variable cost, fixed cost, stepped and semi-variable cost, and also the high-low method. All right, the equation of high-low method is very important. All right, so in high-low method also the challenging part will be this step fixed. All right, so like it will be said that like there will be a cost increase at the highest level of activity which is not in the lowest level of activity. So you should adjust that first before using the high-low method, or else your answer will be wrong. All right, so that's with the cost classification chapter. And next we will be looking at the accounting for materials. All right, accounting for material. So the first thing to know about accounting for material, how the material purchase works. All right, how the material purchase works. So let's look at the cycle. All right, so the main users of material will be the production department, right? The main users of material will be the production department. So guess that this production department had been producing material and they had been out of materials. All right, so if they are out of materials, they will be taking it from the stores, right? Stores is where the materials are stored. All right. So if production department had like have no sufficient materials to produce, they will be asking stores department. All right. And in order to ask stores department, there is a formal note, and it is called goods requisition note. All right. So if production department needs a material from the stores, they will be asking them with a note called goods requisition note. We are requesting the goods from the stores department, and the stores department will give them the material if they have that. All right. So if they have the material, like they will give those material to the production department, and even if they, so assume that if they not have, all right, or if they don't have the material, the stores department is out of materials, so they should like buy it from the outside, right? The stores department is out of stocks, like then they should buy it from outside. So in order to buy that, there is another department called purchasing department. All right. Purchasing department is the department which is taking care of the purchase of material. All right. But purchase department don't know whether they are out of materials or not. So in order to notify them that we are out of materials, the stores department will send a purchase requisition. All right. It means that we are out of stock and we are requesting a purchase. That note will be prepared by the stores department, and it will be sent to the purchase department. All right. So the purchase department will get an idea that these much materials are required for production. All right. So purchase department is the department which orders goods from the external supplier. All right. So the purchase department will give order to an external supplier. All right. And it is called purchase order. Okay. Like it's like order, or like, so like we'll be stating the requirement, like how much quantity do we need, and we'll be giving the order to the external supplier. All right. So along with the purchase order, okay, like while giving the purchase order to the external supplier, the external supplier will do what? They will deliver the goods to the stores department. All right. So the goods will be like delivered to the warehouse only. Okay. So production department like will be a small department. Okay. So in order to store the goods, the best thing is the warehouse. Okay, or the stores. So the external supplier will be delivering these goods to the stores department. All right. And by giving that, they will be giving a note called goods delivery note. All right. By the delivery of goods, like they will be like giving in notes called goods delivery note. Okay. So the external supplier will give that we had supplied like this much amount of goods. All right. So the goods delivery note will be given by the external supplier, but there are chances that the external supplier can show the materials more than what they had delivered. All right. So from our perspective, we should have a confirmation that we got the goods that we had ordered. So the stores department will check the material that had been delivered, and they will match it with the goods delivery note. And if it matches with the goods delivery note, then they will prepare a note called goods received note. All right. It's goods received note. Okay. So the purchase order is also sent to the stores to verify it with the receipt of goods. All right. So the purchase department along with the purchase order to the external supplier, like they will also send the purchase order to the stores department. So that stores department will know. So the stores department will know that how much goods had been ordered. All right. So like they'll get an idea of how much goods had been ordered. So they will match this purchase order with the goods delivery note, and when it matches, they will like generate a goods received note. All right. So this goods received note is prepared by the stores department only, and this copy of goods received note is sent with the purchase order to the purchasing department. All right. So it is sent back to the purchase department, like in order to like know that the purchase like in order to let know the purchase department that the goods had been delivered, and it is matched with the supplier invoice and the payment is made. All right. So the stores department is given confirmation that they had delivered the goods that we had ordered. So the purchase department know that the goods had been delivered as requested, and after that the external supplier will send an invoice or the bill for the payment to the purchase department or the finance department. Okay, like it will be to the purchase department. So the purchase department matches this purchase order and goods received note with the invoice. So by looking at the invoice, it says we should pay for 50 kilogram of material, and by looking at the goods received note, it says we had delivered 50 kilogram. So it matches. So the purchase department can make the payment now. So after that, the purchase department will make the payment, or else like it will be forwarded to the finance department for the payment. Either one will be making the payment. It will probably be finance department in a multinational company. All right. So that's how the purchase of raw material works. All right. And next we'll be looking at the cost associated with the materials or the inventory. So material is like showed as inventory, right? So the cost associated with those is considered. So apart from the purchase cost, all right. So the main cost associated with inventory will be the purchase cost. Apart from the purchase cost, there is inventory holding and ordering cost. All right. So the equation for inventory holding cost is nothing but holding cost per unit of inventory. Okay, it is the cost like the cost incurred to hold each unit of inventory into average inventory. All right. So the equation for average inventory is Q by 2, and the Q is the order quantity. How much quantity we are ordering in a single order. It means that like if I'm placing an order of 500 unit, like then my order quantity is 500. So my average inventory will be 500 by 2, 250. So the holding cost per unit should be multiplied with the average inventory. And next is ordering inventory cost. So the equation for ordering cost is cost of placing an order. All right. The cost incurred for placing each order multiplied by number of orders. It's just a like direct equation. So like the number of orders we are making, the cost incurred for each order. That's like that gives the ordering inventory cost. So in order to get the annual cost, as we know that the primary cost is the purchase cost. So like in order to get the total annual cost of inventory, it would be the total purchase price, the total material that we had bought, and then equation for holding cost. Equation for ordering cost. All right, it is cost per order into number of orders. So in order to get the number of orders, it is D by Q. D means the demand. All right, D means the demand and Q is the quantity. So assume that if the demand for the product is 10,000 units, and in each order we are buying 500 units. So how much order is required? It's 10,000 by 500. How much order is required? It would be 100 by 5. 20 orders will be required, right? So in order to get this 20, we should divide the demand with the order quantity. So that's what gives the ordering inventory cost. So the total annual cost include the total purchase price, the ordering cost, and then the holding cost. The equation for holding cost is holding cost per unit multiplied by Q average inventory, and it is Q by 2. And the reorder level, like reorder level is something till like from reaching how much inventory we should make the order. It means that just think that once I order, just assume that once I order the goods, it will take 7 days to deliver. It will take 7 days to deliver. Okay. So if I order today, the goods will be delivered on the 7th day. So if I order at zero inventory level, then what will happen? I'll be not having materials to produce for the next 7 days, because the next order will be received after 7 days. So in zero inventory level, it will be hard for the company to meet the demand. So that's where the relevance of reorder level came. Reorder level is the level at which the company should make the order. So its equation is maximum usage into maximum lead time. All right. So assume that each day, all right. So let's say 50 kilograms are used each day. All right. 50 kilograms are used each day by the production department. So in order to get the reorder level, the equation is nothing but maximum usage and maximum lead time. So here the maximum usage was how much? 50 kilogram. And the maximum lead time. Like lead time is the time required to get the goods once we order that. So here the lead time is 7 days. So how much would be the reorder level? It will be 50 into 7, 350 kilogram. It means that when the inventory level reaches the 350 kilogram, we should make the order. All right. If we make the order after reaching the in 300 kilogram or something, then we will then we won't be able to meet the demand. So the reorder level is the level at which the next order should be made. That's it. And here next we will be looking at the limitations of low inventory level. All right. The first limitation is that customer demand may not be satisfied. Okay. If we maintain low inventories, there are more chances of stock outs. So in some cases, the material will not be available to meet the production. So the demand would be so the demand may not be satisfied, and and it will lead to loss of customers. And not fulfilling important customers, costly emergency procedures may be required to maintain customer goodwill. It means that we do not have material now, but now we have to meet the a critical customer demand. like that customer is more important to us, so we should meet their demand. Okay, so for that, we want inventory in a emergency way. Okay, so in that case we will not be looking at the cost for the purchase. So there are chances that we'll be incurring a high cost of purchase and high cost of traveling, the ordering cost associated. So that's the second disadvantage of lower inventory level. And the third is that more frequent orders would be required than the higher inventory level, resulting in higher ordering cost. It means that usually I used to purchase 500 kilogram of material, and if now I am purchasing only 100 kilogram and the demand is same of 10,000 kilogram, what will happen? The number of orders will increase. That's the next limitation. If lower inventory levels are held, then more frequent orders will be required to make, and this will increases the ordering cost of the company. And next we will be looking at the limitations of high inventory level. So the equation of so the main limitation is that the holding cost would be high. All right, the holding cost associated with the higher inventory levels will be high. And the next is that cost of capital locked in inventory may not be possible to pay bills. It means that, so we'll be having a working capital, right? All right, so our working capital will be mostly in the inventory level. It means that if I had 10,000 cash in hand and I purchase the material using that whole 10,000, then then I'll be not having money to pay my suppliers. All right, so my payables will be pending. All right, so the cost of capital will be locked in inventory. So in order to get the money, I should sell that inventory. That's the another limitations of maintaining higher inventory levels. And the next is chances of product to become obsolete. Okay, so if I stock the inventory at a higher level, I stocked a large number of inventories in my stores, there are chances that the material may become obsolete. All right, so they may become damaged. Then we can't sell them at regular price. All right, so we should scrap them, and in certain cases we should pay to the scrap to make the scrap, right? So in order to scrap the material, we will be incurring a cost. All right, so this is the another limitations of maintaining higher inventory level. The product may become obsolete, so we can't further process or sell them at the regular price. Okay, we'll be required to scrap them at a cost maybe. And the next is sudden drop in market price of material represent high price of raw material. It means that I bought the material at 2 per kilogram 2 months ago. All right, but now it can be bought at $1 per kilogram. So that is kind of loss, right? If I had not purchased the whole material 2 months before, I can purchase the some materials at a cost of $1 per kilogram. So the sudden drop in market price of material represent high price of raw material. All right, so that's what the another limitations of raw material. Okay, so the cost of raw material will be $2 per kilogram in the inventory, not $1 per kilogram, but now it's available at $1 per kilogram. All right, so that's what the limitations of higher inventory level. Next we will be looking at the economic order quantity. All right, so there are certain limitations for maintaining higher inventory level and also for maintaining lower inventory level, right? Both have its limitations. So what we can do is we can reduce the limitation. All right, by increasing the order quantity, it will be higher inventory level. By decreasing the order quantity, it will be lower inventory level. So economic order quantity gives the quantity. I mean, it gives how much quantity we should order in each order, where the ordering cost and holding cost will be minimum, not zero but minimum. All right, so it gives a quantity that we should order, at which the ordering cost and holding cost will be minimum. All right, and the equation for economic order quantity will be square root of 2 COD divided by CH. All right, So like D is the demand, CO is the cost of placing an order, CH is the holding cost. All right. By getting the square root of this equation, we will be getting the economic order quantity, the quantity we should buy in order to get the holding cost and ordering cost at a minimum level. And the assumption made in EOQ is that the demand and lead time is constant and known. All right. So the demand of product will be constant and the lead time will also be the same. Okay. All right. So like if the lead time is 7 days, it will be 7 days itself. And the next is purchase price is constant. All right. So the material is like available at the same price for the entire year. And the next is no buffer inventory. All right. No buffer inventory is held. So the buffer inventory is a level of safety inventory like that the company uses in order to reduce stockouts. But in this case, no buffer inventory is held. All right. And the next is EOQ with discount. So assume that the economic order quantity. Okay. Let's say the economic order quantity was 1000 units. It means that in 1000 unit, the holding cost and the ordering cost is minimum. The holding cost will be minimum and the order cost will be minimum. But if supplier say that if you buy a quantity of 2000 units, if you like if you buy 2000 units in a single order, I will give you 5% discount. All right. So since you are increasing the quantity from the EOQ, obviously the holding cost will increase and the ordering cost will decrease. All right. But in order to look that, but in EOQ, both holding cost and ordering cost is minimum. So in order to get whether we should accept the discount, we should compare the total cost at EOQ and the total cost at the supplier side quantity Q. So in this case, first we will be looking at the total cost at 1000 units. All right, or the total cost at EOQ, and the next is total cost at 2000 unit. So the total cost would contain purchase price, ordering cost, and holding cost. Right, it will give the total cost. Okay, so by comparing this total cost, if the total cost of 2000 unit is less, then we can accept the supplier demand, because like if we suppliers discount, because if we accept the supplier discount, like then our total cost will be less than the total cost at EOQ. All right. So it will be, so in discount the purchase price will decrease. So like he's giving a 5% discount, right? So the purchase cost will be decreased, but the holding cost will increase. Okay, the number of ordering quantity will increase, so the holding cost will increase, but the ordering cost will decrease as the number of orders is decreased. And so this is what we do like when we are having a discount. So if discount is available, calculate total purchase cost with EOQ quantity and compare it with considering discount. Pick the one with less purchase cost or less total cost. All right. So that's how we should determine whether we should accept the supplier's discount or not, by comparing the EOQ with the with the proposal made by the supplier on the purchase of the goods. That's it. And next we are looking at the economic batch quantity. All right. So the economic batch quantity is not so important as economic order quantity, but still let's look. So the equation for economic batch quantity is that 2 COD divided by CH into 1 minus D by R, and Q is the batch size. So it is to look that how much unit should be produced in each batches. All right. So let's say in one machine, all right, in a one single machine, two products are produced. Okay. So in a one single machine, a product A and B are produced. So we should look at how much units of A should be produced in one batch. Okay. So in order to determine how much units should be produced in each batches, we use economic batch quantity. So the equation is the batch size. Q is the batch size, and D is the demand per annum. All right. And CH is the holding cost, and CO is the setting up cost. All right. So after making the product B, then we should set up the machine in order to produce A. So the cost associated with the setting up of the batch, and then is annual replenishment rate. The annual replenishment rate is how much quantity is used in each year. Okay, so that will be directly given in the question. All right. So by using this, we can get the economic batch quantity. Next, we will be looking at the inventory valuation method. Okay, so like you had studied this in FA actually, so it's not so important in MA. Okay. So the inventory valuation method inventory valuation methods are first in first out, last in first out, and average accounting, ACCA. Okay, so these are the inventory valuation method. So in first one method, like we'll be valuing inventory based on the, so like the what comes is like the what comes first will be like will be valued at the what goes out first, and like the LIFO is the opposite. Okay, so the last one like comes in will be valued to the first one goes out, and next is average AVCO. So we will compare the average cost of inventory. All right. The next is material inventory account. As you know that material is a current asset, right? As you know that material will be a current asset, it has a debit balance. Alright, it will be having a debit balance. So the opening balance will be on the debit side. Okay. And payables indicate that we had purchased more material. Alright. So if payable increases, it says like we had purchased more material. So like our inventory level is increased. So our inventory level is increased, it is debited. So like it will be on the debit side, and then it's material returned to stores. Okay, it means that some material had been taken by the production department for the production. So the material is like, so the inventory level is decreased, but they have left some to the like stores department like, since they are not required. So the inventory level increases again. So the material returned to stores, increases the inventory level. And so that's the three factors that mainly increases the inventory level. And the next is and what decreases the inventory level is work in progress. It means taken for production. So if some items are taken for the like production by the production department, like then the material inventory account is credited because the level is decreased. And next is material returned to suppliers. If we had bought some materials and it got damaged, we had replied it to the supplier. So like it is returned from stores to the supplier. So the material is decreased if material is returned to supplier. And next is production overhead account. It means that some material will be taken for the overhead purposes. Okay, let's say oil used to like let's say the oil used in the machine to operate. So in order for the machine to operate, we'll be like using some ink or some, let's say, oil or something. So like that is not directly involved in the production. Okay, so it will be included in production overhead account. And next is statement of profit or loss. The damaged inventory will be going to the statement of profit or loss. So let's say if some inventory got damaged, we can't sell that. All right, but we had bought it at a cost. So that cost should be shown as a loss now. So in that cases, it will be credited to the SOPL. Sorry, like it will be debited to the SOPL, but it will be credited from the material inventory account. So these are the four factors that will decrease the value of inventory or the value of stores. And after that, we will be getting the closing balance. That's how the material inventory account works. All right. So now we had done with the chapter of material inventory, the important factors in which like associated with this had considered. All right. Just give me a second. Let me get some water. Okay, let's start. So now we had done with the material chapter and accounting for management and also the cost classification. Next we will be looking at the accounting for labor chapter. All right. So accounting for labor is mainly based on the payment made to the laborers. All right. It is mainly based on the payment made to the laborers and the classification of labor cost. So the labor can be paid based on two bases. Okay. The labor can be paid either based on wages or salary. All right. If it is based on wages, it is a variable cost because they are paid either based on the hour or based on the unit they produced. So if it is based on the unit they produce, it is called output related systems. Okay, if they are producing like 100 unit, they will be given the payment for producing 100, and if it 200, it will be increased. So that's what output related system means. So the equation for output related system will be like, so the total wages will be the number of unit produced multiplied by rate of pay per unit. Let's say an employee had produced 100 unit and the payment for each unit is $5. Then the total wages will be how much? $500. This is the equation for output related system. Okay, and there are two types of payment actually. All right, like there is this straight piecework system and differential piecework system. So the straight piecework system means that regardless of the number of units they produce, even if the labor produces 10,000 units, let's say, for the 10,000 unit, the payment will be this $5 only. It means the same rate will be paid regardless of the number of units produced. That's what straight piecework system means. But in differential piecework system, the rate paid will be different at different levels of production. So let's say the manager is saying that if you produce from 0 to 100 unit, your payment will be $5. And if you produce like, so like till 100 unit, your payment will be 5 per unit. And from 100 to 500 unit, your payment will be $8 per unit. This is how differential piecework system works. It means that the rate of pay will be different at different units of production. So till a certain level, like the payment will be 1, and after exceeding that level, it will be increased. All right, so that's what differential piecework system means. And next is the incentive schemes. It means that how the bonus is paid. All right, so if a labor had completed their production with the time which is less than the budgeted time or the time given, then like he will be given bonus for saving the time. Okay, so there are two ways in which the bonus can be paid. So the first equation is time allowed divided by time, time allowed minus time taken divided by 2 into time rate. So this is the one equation that is used to calculate the bonus. And the other equation is that time taken divided by time allowed into time rate into time saved. All right, so this is the other equation for the bonus calculation. But don't worry, like this equation will be given in the question. All right, so there is this two basis for bonus calculation, and the basis will be given in the question. All right, so this will be provided in question, right? So no problem. So that's what with incentive schemes. And next we will be looking at the direct labor and indirect labor. So direct labor are part of the prime cost of product, which include the basic pay of direct workers. All right, so the direct labor cost means the laborers who are directly involved in the production. If we are a soap making company, the employees who are making the soap are the direct laborers, and the person who is maintaining the machine, the person who is changing the, let's say, like dye in the machine, they can be considered as the indirect labor. All right, so in direct labor cost, we will only include the basic pay for direct labors. All right, so the basic pay for direct labors will only be included in the direct labor cost. So the direct labor cost only contains the basic pay for direct labors. Indirect labor contains basic pay for indirect labor and also the bonus payment, benefit, etc. Okay, so basically direct labor cost only contain the cost incurred for the production, the cost we are paying for them to produce. If we are paying them for on their leave, if they are paying them a bonus, they are not related to the production, so that will be considered as indirect labor cost. All right, so the pay which is not the basic pay for the direct labors, rest will be the indirect labor cost. All right, and next we will be looking at the overtime and the overtime premium. All right, so here we should look at the two terminologies. It's overtime payment and overtime premium. So overtime payment is the total payment made to the employees working overtime, which includes the basic pay. All right, so if an employee is working regularly, their basic pay is, let's say, $5, and if they work overtime, their pay will be $8. So this $8 is considered as the overtime payment because it contains both basic pay and overtime premium, let's say. So this is the overtime payment, the total payment made for the employees to work overtime. And overtime premium is the extra amount which is more than the basic pay that is paid to the employees working overtime. So here the basic pay for employees was $5, right? Here the basic pay for employees was $5, and for working overtime we are paying $8. And this like $8 contains the basic pay of $5 and also an increased amount. That increased amount, so here it is $3. It is the overtime premium. So overtime premium is the extra amount more than the basic pay that is paid to the employees worked overtime. Alright, that's what overtime premium means. The premium amount made in addition to the basic pay. That's the overtime premium. Overtime payment is the total amount paid for working overtime. That's it. And the overtime premium will be included in the direct cost. Sorry, include as this song. It is included as direct cost, right? Okay. So the overtime premium is included as direct cost. Sorry, 1 second. Okay. So here the overtime payment will be included as indirect cost unless we are working for a specific request of a customer. It means that the labor is working overtime by the request of a customer to meet the demand. Then the overtime payment will be included as overtime payment will be like the overtime premium will be included as direct labor. All right. Rest in all cases it will be indirect labor cost. So in like only in one situation the overtime premium will be included as direct labor. It will be when the labor is working for the specific request of a customer or in order to meet the demand for a customer. Okay. In that case only it is included as basic pay. And this is the T account for this labors. All right. So like when we pay to the labor, it's debit because like it is an expense account, right? Like the labor is an expense account. So when we pay them, it's like bank or cash, like it will be debited, and the salary or the wages will be paid to the like direct labors or the basic pay. Okay, or the basic pay, like it will be included in the work in progress. Okay, and in production overhead, it will be indirect labor, overtime premium, idle pay, or sick pay. All right. So it means that if the company pay 10,000 to the laborers, this 10,000 may contains basic pay, pay for indirect labor, pay for overtime premium, pay for idle time, and sick pay. Okay, so collectively it will be 10,000, and after that we will be like classified them like based on the type of payment that is made. All right, that's it. And then we will be looking at some equations of labor. So the first is the labor turnover ratio. So the equation is number of leavers who requires replacement. All right, like the number of leavers who requires replacement divided by average number of employees into 100. Okay, so that's the equation for the labor turnover. Okay, so for a company with less labor turnover is more success, right? So like if the labor turnover is more, like it means that like the labor is keep on like moving from the company. All right, like it means that like the more number of laborers are leaving the company. And the next is labor efficiency ratio, and the equation is standard hours for actual output divided by actual hours worked for output into 100. It means that in order to produce 100 units, he is given 2 per unit, and like the standard hours was 200 hours, and he had completed it in 150 hours. So the efficiency ratio will be 200 standard hours for actual output divided by actual hours into 100. And the next is idle time ratio. It will be the total time like in which the like employees didn't work divided by total hours into 100. This is idle time ratio, and then there is labor capacity ratio. It is the actual hours worked by the total budgeted hours into 100. That's the equation for labor capacity ratio. All right, and then there is production volume ratio. It is standard hours for actual output divided by budgeted hours into 100. Okay, so you should by heart these equations. All right, like there is no shortcut. You just need to like by heart this equation for the exam. That's it. So now we had done with the chapter for accounting for overheads. Now we will be looking at, sorry, accounting for labor. Now we will be looking at the chapter called accounting for overheads. All right. So in accounting for overheads, we will be looking at different types of expenses. So direct expenses are the expenses that can be directly identified within a specific unit or a cost center. Okay, so that's the like direct expenses. Like it can be like seen in a specific cost unit or a cost center. And indirect expense is it cannot be like directly identified within a cost unit or a cost center. It means that like those are indirect. So like the reason is that we can't identify them in a single cost unit. Okay, it will be incurring as a whole. Let's say administration cost. Okay, the administration department will be working for all the department. So we can't say that they are working for the specific department. They will be working for all the department or the HR in a company. Okay, the HR in a company will be like working for the production department, sales department, and like every department in which the like in which humans are working. So that's indirect expense means. All right, we can't identify them in a single cost unit or a cost center. That's what indirect expense means. And then there is two costing methods such as absorption and margin. So in absorption costing, like so this accounting for overhead is like mainly based with the absorption costing. All right. So in absorption costing, production overheads are recovered by absorbing them into a cost of a product. All right. So it's just simple. Okay. So like let's say we have a order of overheads of $1,000 and we are producing 100 unit. Then we will be charging each of the 100 unit for $10 as overhead. Okay, like that's what is like doing in the absorption costing. The production overheads are recovered by absorbing them into the cost of a product. Okay, so this $10 is absorbed from each of these 100 unit in order to get the overhead of $1,000. And next is the basis of apportionment. How we can apportion the overheads to different cost unit or cost centers. All right. So there is not a particular rule as a base of apportionment. It should be fair. That's it. Each company can use different methods for the apportionment of overhead. There is no certain rules for that. The thing is that it should be fair. That's it. So there are three types in which we can reapportionment. So like we can like reapportion the cost. So like let's say this is the company. All right, this is the company we are working on, and this company has got, let's say, production department A, production department B, production department C, and then there is canteen. Okay, then there is canteen. So if they incur a rent of 10,000, the 2,500 will be allocated to production department A, 2,500 will be to B, 2,500 will be to C, and 2,500 will be to canteen, because they are sharing the exact same floor area. All right, but this canteen itself is not producing any item. This canteen is working to produce service to this production department. All right, this canteen is like working to provide this like services to this production department, right? So this canteen is a service cost center. They are not producing any unit. So the reason for this 2,500 for the canteen are the production departments of A, B, and C. They are the reason for which canteen is working and the reason for which the canteen is allocated a overhead. So before allocating the overheads to each of the unit, I mean like before this step of allocating the unit, like we should allocate the cost which is allocated to service cost centers to the production cost centers. Okay, so that's what's said here. Reapportionment of production service cost centers to the production cost centers. All right, so the cost allocated to service is reallocated to the production cost centers. So there are three methods. One is direct method. Okay, in direct method, the cost of each production service cost center is reapportioned to the production cost centers only. It means that this 2,500 will be allocated to like production department A, B, C, and D. Okay, So let's consider a different situation. Okay, here is also there are this thing and the production department A, B, C. Then there is canteen and also the maintenance department. Alright, the maintenance department is also working to provide services to the department A, B, and C. This department is also having food from the canteen. It means that the maintenance department, which is a service cost center, is also having food from the canteen. So they are also responsible for the cost incurred for the or the cost allocated for the canteen. Alright. So in that case, we'll be using step down method. So in step down method, like it is used when one production service cost center works or provides a service for other service cost center but not given back. It means that one service cost center is providing service to the other cost center, but that cost center is like not giving back. Here the maintenance is not providing service to the canteen, but canteen is providing service to the maintenance department. So in that case, we will be using step down method. Alright, and then there is reciprocal method. It means if canteen is providing services to maintenance and maintenance is like providing like service back to canteen, like it means that like they are giving services to each other, then we'll be using reciprocal reapportionment. All right, so these are three methods, all right, for the apportionment of overheads. All right, and then we'll be looking at the absorption of overhead. All right, how like so let's consider another example. So the equation for overhead absorption rate is budgeted production overhead divided by budgeted base. Alright, it means at what rate each product will be charged with an overhead. Alright, since overhead is an indirect cost, we should be charging each unit with an overhead. So the equation is that budgeted production overhead divided by budget base. Okay, so let's assume that at the year start, alright, at the year start, the company had budgeted an overhead of $10,000. Okay, and the company's budgeted units, and the company had also budgeted to produce a units of 1,000 units. So these both are budgeted. In this case, the overhead absorption rate will be how much? The overhead absorption rate will be $10,000, which is the budgeted production overhead divided by budgeted base, which is units. So the overhead absorption rate will be how much? It will be $10 per unit. Okay, $10 per unit. So here the $10 per unit is the overhead absorption rate. So what's the meaning of this? In the cost card for that unit, the overhead that will be included is $10. It means that for each of the unit that is selling, we are charging $10 as the overhead. All right. So since this, okay, so we had planned this at the year start. Okay, so we had made the budget and the budgeted unit, and year ended. All right, assume that the year ended. So when the year ended, the budgeted overhead was, let's say the budgeted overhead was $11,000. Okay, like we expected that the cost would be $10,000 only, but the actual cost incurred was 11,000. Also, the unit sold. Okay, so sorry, so this is not the budget overhead, this is the actual overhead. So here the actual overhead was $11,000. And the actual unit sold was, here the actual unit sold. The actual unit that we sold was, let's say, 900 units. All right. It means that we had budgeted our overheads to be 10,000, but our actual overheads was 11,000. And we had budgeted to sell 1,000 units, but we only sold 900 units. So we should understand, like if we had a gain or loss in this situation. All right, that's where the concept of under or over absorption of overhead comes. It means that whether we had absorbed sufficient overhead to meet the actual overhead incurred. All right, so here the actual overhead was how much? Here the actual overhead was 11,000. And how much was the absorbed overhead? Okay, so our overhead absorption rate was $10, right? It means that for each of the unit we are selling, like we'll be charging $10. Okay, and currently we had sold 900 units. So how much overhead had been absorbed? It will be 900 into 10, which is $9,000. All right. So this $9,000 is the absorbed overhead. It means that on the sales of this 900 unit, for each unit I had charged an overhead absorption rate of $10. So the total absorbed overhead was $9,000, but my actual overhead was 11,000. So I had incurred a cost of 11,000, but I got only 9,000. So this is under absorption. So it means that my absorbed overhead is less than the actual overhead. It means when the absorbed overhead is less than the actual overhead, it is under absorption. So in same case, assume that the unit sold was, let's say the unit sold was how much? Let's say the unit sold was 1,200 units. Okay, so we had sold 1,200 units. Then how much would be the absorbed overhead? So in this case, how much would be the absorbed overhead? The absorbed overhead would be how much? 1,200 into 10. It will be how much? 12,000. It means that I had only incurred a overhead of 11,000. Okay, I only incurred an overhead of 11,000, but I got back 12,000. It means that I got $1,000 more. This is called over absorption. It means that the absorbed overhead is more, actual overhead is less. This is what over absorption means. So in order to calculate the under absorption or over absorption, first we should calculate the OAR, then the overhead absorbed. It is OAR into actual level of activity. Then we will be comparing it with the actual overhead incurred. So if the absorbed overhead is greater, it will be over absorption. Absorbed overhead is lower, it will be under absorption. That's it. And then we'll be looking at the different types of costing method. All right. So here is this absorption costing and marginal costing method, right? So in marginal costing method, the marginal production cost only contains the variable cost. All right. So the fixed cost is considered as a period cost only. That's how marginal costing work. And the equation is, so by using marginal costing, first we will be getting the contribution. And the equation for contribution is sales price minus all variable cost. We will be deduct all of the variable cost from the sales price and the contribution per unit. So the equation for contribution per unit will be sales price per unit minus total variable cost per unit. So we will be getting the contribution per unit. And in order to get the total contribution, we should multiply contribution per unit with the sales volume. And in order to get the profit, we should deduct the fixed cost from the total contribution, because the total contribution only included the variable cost. In order to get the profit, we should also deduct the fixed cost also. Okay, in absorption costing, as we know that we will be allocating fixed cost to each of the unit. All right, so it is a method of building full production cost which adds variable cost and also the apportion to fixed cost for the each product. All right, so in inventory valuation also the absorption costing will contain total cost, but in marginal costing the inventory valuation will only contain the variable cost. All right, and in inventory valuation, all right, so the inventory values will be different if using marginal or absorption costing, because the marginal costing only contains variable cost, but the absorption costing contains total cost. All right, so as the inventory value would be different in absorption and marginal costing method, the profit would also be different, right? Since you are valuing using different values, then the profit will also be different when using absorption and marginal costing method. All right, so if the inventory level increases, the profit on absorption costing would be more, because the absorption costing contains the fixed cost which is not included in the marginal costing method. All right, so the closing inventory value, okay, so the closing inventory value will be more if the inventory level increases in absorption costing. So as the closing level increases, cost of sales decreases. If the cost of sales decreases, profit increases. All right, it means if closing inventory increases, cost of sales decreases, and if cost of sales decreases, then our profit will increase. That it is said here. If inventory level increases, the profit on absorption costing will be more. But what if the inventory level decreases? The profit on marginal costing would be more. And if the inventory level is same, both method gives the same profit. And this is the pro forma for absorption costing SOPL. And it is sales, cost of sales, opening inventory, variable cost of production, fixed overhead absorbed, like less closing inventory. And here we will be adjusting the under or over absorption of overhead, and then we will get the gross profit, then on production cost profit. So this is the pro forma for profit statement using absorption costing method. Alright, and this is for marginal costing. Alright, in marginal costing we'll be considering fixed cost at last only. Alright, so the inventory valuation will only contain variable cost. So the equation will be sales, or in cost of sales it will be opening inventory, variable cost, closing inventory, then other variable cost, and then we will get contribution. And by deducting fixed cost from the contribution, we will be getting the profit or loss. Okay, and next we will be looking at the advantages and disadvantages of marginal and absorption costing. So the advantage is that contribution per unit will be constant, unlike profit per unit. It means that as it only contains variable cost, the contribution per unit will be constant, but profit per unit can increase or decrease based on the budget level of activity. And the next is there will be no under or over absorption of overhead. Okay, the under or over absorption will only be on absorption costing method, and fixed costs are period cost and are charged on a full period, right? So we will be charging fixed cost at last only, right? And it is useful for decision making, and also it is simple to operate. And the advantage of absorption is that it is the costing method which aligns with the IAS2 inventory, because in according to IAS2 inventory, the all cost that is associated with the inventory should be used in the inventory valuation. All right, so in absorption costing we are considering both variable cost and fixed cost. Okay, but in marginal costing we are only considering the variable cost. And by analyzing the under or absorption, we can control the cost. So we can know that where to control the cost by using under absorption or absorption, and it is useful for small organization to estimate cost on profit and jobs. Okay, so the absorption costing will be mainly used by the small organizations. That's it. So that's with accounting for overhead. Next we'll be looking at the job, batch and process costing. Okay, so next is job, batch and process costing. So job costing means specific order costing, and it is used when a customer orders a specific job to be done. Okay, it means that a separate job only. Okay, if a person is doing a separate job, in order to calculate the cost, then we will be using the job costing method. All right, and then there is batch costing. It means batches of identical units are produced and each batch will be different. All right, so here we are producing a products in a batches. All right, so we are producing same product, same unit in a batches of, let's say, 500 or 1000 units. Okay, so the equation will be total production cost of batch divided by number of units in the batch. And then there is process costing. Process costing is that when the goods are produced by going through multiple processes. All right, so multiple processes are included for the production. So when goods are produced from a sequence of continuous or repetitive operations or processes, then it is called process costing. All right, and the equation would be net cost of input divided by expected output. Okay, so the equations of average cost per unit will be net cost of input divided by expected output. All right, so in process costing we will be looking at 4 situations. Okay, so there are 4 situations which are which can occur in the process costing. And the first situation is total input is equal to total output. All right, so if we input 1000 unit, then the output is also 1000 unit. So the pro forma will be the value which is the value of goods which is transferred from the previous process, then the labor and overhead incurred in the current process, and the amount which is transferred to the next process. So this is the pro forma for process account with no loss. And then we'll be having a normal loss. It means that I know that a loss can incur. It means that I know that if I input 1000 unit, I will only be get 960 unit as output. Okay, so here the 4 unit will be the normal loss. here the 4 unit can be considered as the normal loss, because I can like it is the like normal loss that can like that can happen while processing the goods. All right, so it is the like if actual loss happened is same as expected loss, like then it is normal loss. Okay, so the like expected loss is the normal loss. Okay, so here like I expected that my loss will be 14 unit and my actual loss was also 14 unit, like then it is a situation of normal loss. All right, so here the total output is equal to total input minus expected loss. So here my input was 1000 and expected loss was 40, so my like total output is 960 unit. All right, in that case the average cost per unit will be total cost of input minus scrap value of normal loss divided by input unit minus normal loss unit. All right, so this is the equation for average cost per unit in case of normal loss and scrap value. All right, so this is the process account pro forma. So it is like same as the previous one, like the like value transfer from the previous process, direct labor, overhead, then like transfer to the next process, and then there is normal loss. All right, so the normal loss will also be included in the credit side of the process account, right? And next we'll be looking at the abnormal loss. Okay, so here my expected loss was 14 unit. Okay, here my expected loss was 40 unit, but the actual loss was, let's say, 15 unit. Okay, so this is a kind of abnormal loss. The actual loss had been more than the expected loss. I expected that the loss would be 14 unit, but the actual loss was 15 unit. So it's abnormal loss. 10 unit had been lost more. Okay, so and also the main point was the abnormal loss or gain does not affect the average cost per unit. Okay, so the average cost per unit will be same here. All right, so this average cost per unit will not be affected by the abnormal loss or gain. Okay, because the equation for average cost per unit is total cost of input, scrap value of normal loss, input, normal loss unit. Okay, so the abnormal loss or gain will not be affected, like will not be affecting the average cost per unit. Only the normal loss will be affecting the average cost per unit. All right, and the like pro forma will be the same, like transfer, direct labor, overhead to the next process, normal loss, and also abnormal loss. All right, so in case of abnormal loss, an abnormal loss like unit will be like, let's say like here the abnormal loss was 10 unit, so the value of 10 unit, okay, will be included in the abnormal loss statement. And then there is abnormal gain. Okay, for like since the like abnormal loss is shown on the credit side, the abnormal gain will be shown on the debit side. It means that my expected loss was 14 units, but my actual loss was only 13 unit. It means that my actual loss was less than the expected loss. Okay, so in that case abnormal gain will occur. All right, and then there is working process and equal units. So let's say that like in a certain process some unit will be left to the complete production. All right, so let's say like if a product is 70% complete or what, in that case but we can't get the cost of the part completed unit. Okay, so let's say 100 unit. Okay, so let's say with example. Okay, so in some cases some unit that had been in the production process may not be fully processed. In that case the part processed units as a whole is considered as fully processed unit based on the proportion of completion. So we'll be considering the whole of the part processed as a completed like units of less amount. So like let's say if 100 unit was 60% completed, we will be considering this as a 60 units which is fully processed. So we'll be valuing 60 unit at their total cost instead of 100 unit with 60% completion. All right, so that's with equivalent units in work in progress. And then we will be looking at the joint and byproduct. All right, so the symbolic so the like example we can be saying in like joint and byproduction is the crude oil. All right, so as we know that when we get crude oil after some processes, it will be converted into petrol and diesel. So this is what joint product means. I mean two products are getting from, or two or more products are getting from a single process. Okay, that's what joint product means. So joint product are two or more products separated in a course of processing, each having high saleable value. Okay, like here the petrol and diesel have like almost same value, right? So like that's what like joint product means. And byproduct means are the output which are produced incidentally with the main product. Example, sawdust from timber. Like it means that like we are not getting like byproduct as we like intend to get that. Like we are getting it like unexpectedly. Okay, let's say like waste or something. Okay, so here the sawdust from timber. It means that the like the powder of timber, right? So that like it can be considered as a byproduct. Okay, so we can sell it on the same value as of the actual timber, right? So the joint cost incurred till the split off point. Okay, so the joint cost is something that is incurred till this like split off point. Okay, so till this amount. All right. So the cost incurred within this can be considered as joint cost. All right. So the joint cost incurred till the split off point or the point of separation into like movement can be like divided into joint product. Okay. So we had incurred a joint cost, and we should allocate this joint cost into this petrol and diesel, right? So in order to allocate this joint cost, we can use three methods. Okay, so it can be based on sales value of production or the production unit or on the basis of NRV. So these are the three bases which we can allocate the accounting treatment for joint and byproduct. All right. And next we will be looking at the accounting treatment for the byproduct. Okay, so there are like, so we can account this like byproduct on like on the basis of like non-cost or the cost method. So if it is based on the like non-cost method, like it will be shown as other income. All right, so the income from the sale of byproduct will be included as other income in SOPL, or the income is like deducted from the main product cost. All right, it means that the income from the sale of byproduct is like deducted from the cost of the main product, or else we can use cost method such as the replacement cost method. It means the market value. All right, so the market value like of byproduct is considered when using cost method, or else total cost less byproduct value at standard price method. It means the total cost. Okay, so the total cost is byproduct value is standard price. Like it means that the byproduct is valued at a standard price. Okay, so regardless of the actual cost, we'll be valuing the byproduct at the standard price, like which had been set already. And the next is joint cost pro rata method. All right, it allocates sum of joint cost to the byproduct. All right, it means like the joint cost. All right, so in case of timber, okay, in case of timber, after process we will be getting both furniture and sawdust. All right, so the joint cost will be allocated to both sawdust and furniture. That's what joint cost pro rata method means. Okay, and next we will be looking at service and operation costing. So the characteristics of like service costing is that it is intangible, can't be seen, heterogeneity, like each services will be different, simultaneous production and conversion, like we can store the service. All right, like we can't store the service, we can just provide them. And next is perishability, it can't be stored, it is easily perishable, like it will be finished like as soon as it is provided. So the equation for service unit is total cost for providing the service divided by number of service units used. And then we're looking at the alternative costing principle. All right, so the company will be using different costing principle like based on the requirement. So the first one is the activity based costing. So in activity based costing, like we will be absorbing overhead on the basis of reason for the overhead. All right, so previously we will be like blindly allocating overhead like on the basis of a budgeted base, like the total overhead is allocated on the base of a base. But here we will be considering the reason for the overhead, the reason for the rent, the reason for the supervisor, like the reason for administration and all. Okay, so there are these like two definitions. All right, so the cost pool is an activity that incur cost, rent, like for example rent, supervisor cost, all. So it can be considered as a separate cost pool, and for each cost pool there will be a cost driver which drives the overhead to be incurred. For the reason for like, so what would be the like reason for the rent? Like the reason for the rent would be this increase in floor area. So the cost driver for the cost pool of rent will be the floor area. And in case of supervisor, all right, so what will be the reason for increasing supervisor cost? Like it will be the number of employees. So the cost driver will be the number of employees for the cost pool of supervisor cost. All right, and the use of ABC costing, like it will be helping more accurate allocation of overhead to units rather than absorption costing. Because like it is not like blindly based on a single basis of allocation. All right, so it will be helping like more accurate cost allocation, so we can use them to allocate overhead. And the like advantage is that we can get more accurate cost per unit, better insight on overhead cost, and also it recognizes that like not all overheads are related to the production and sales volume. There are like other reason for incurring overheads also, and it can be applied to all overhead cost, like not just production overhead. Okay, and the disadvantage is that ABC will have like limited benefit if costs are mostly volume based. It means that the 90% of cost is variable cost and only 10% is fixed cost. Like the time we are wasting to allocate this fixed cost for this 10% would be irrelevant. All right. So like it will be having a less benefit if the costs are only like if the costs are mostly based on volume based. And next is it is impossible to allocate all overhead cost to a cost driver. All right. Some cost like we can get a cost driver. So that's the limitation. And next is the cost may not justify the benefit. It's the cost benefit analysis. So when comparing the benefit we are like getting from using the ABC costing will be less than the cost incurred for allocating using ABC costing. So that's also a limitation. And the next is target costing. Here the product cost is estimated by subtracting the desired profit margin from competitive market price. It's just assume that the price for a pen is $10. So this is the price and the profit I require is $2. So what will be the target cost? The target cost would be $8. So this is what target cost means. The product cost is estimated by subtracting the desired profit margin. Here $2 from the competitive market price. Here the competitive market price is $10. All right. So the actual cost like that should incur should be within the estimated target cost. Like it means that the maximum cost like that should be like incurred for the production of pen is only $8. So that is our target cost. And life cycle costing, it tracks and accumulates the actual cost and revenues of a product from inception to abandonment. Like it means that the cost incurred for a production from starting of the research till the like end of the sales is considered in life cycle costing. So like in life cycle costing it considers the whole cost of the product from start to end. All right. And next we will be looking at the source of data. Already, so the source of data is mainly concerned with the like the type of data and all. So first is primary data. It is obtained directly from 1 second. So the primary data. So the So first is primary data. All right. So the primary data is obtained like directly from first-hand sources, like by means of surveys, observation, or experimentation. So that's the definition of primary data. And secondary data, it is previously collected. All right. So secondary data is something that is previously collected, but there are some issues with secondary data. Okay. Like this data has been collected by someone else. It questions the reliability on data. All right. It questions the reliability of data, right? It questions the reliability of data. And then is data up to date? Like if the data is like from the like 2 years before or something, like there are chances of getting outdated, right? And the data may be incomplete. All right. So the secondary data like so they had collected data for their purpose and we want that data for like in some cases some data will be missing. Okay, so the thing which we need like will not be in the secondary data like that we got. And next is nominal data. It is data type that is used for naming or labeling variables without any quantitative value. Okay, so nominal data like there is not any quantitative value to consider. Okay, so there is not any like numbers or something. So the example is blood type, gender, and all. And next is ordinal data. It is data type with a set order or scale to it. All right, so we can like measure the scale. Okay, like it has a quantitative value. All right, so this order like does not have a standard scale to measure. Okay, so there's not a like standard scale, but still we can measure the level. Let's say happiness level or age groups. So let's say like rate your happiness level from 1 to 10 is ordinal data, or like age group from let's say 5 to 15 years of age. It is also a ordinal data. And next is like discrete and continuous data. So discrete data is like it is a non-continuous data. It can only take certain level with no decimal. Alright. So the value of like discrete data will be a whole number, not decimal. Example, like number of people in the room. Okay. So can we say that like there is like 1.5 people in the room? No, like it will always be a whole number. And in continuous data, like there can be decimals. It can take any value. Let's say time or distance. Okay. So the distance can be like 1.8 kilometer, 2.8 kilometer. So it can take any value. So that's what continuous data means. And then there is internal source of information. So the main internal source of information is accounting system, payroll system, strategic planning system. And the, like external source of information can be like let's say like government sources, business contacts, or internet. Like those are the external source of information. Okay. And next we'll be looking at the different types of sampling techniques. All right, different types of sampling techniques. So the first technique is the random sampling. So it's just like we'll be selecting any of, okay, so here we'll be selecting, like the sample is taken in such a way that like every method has a chance of being selected. So it means that like we are just like randomly selecting the samples from the population. All right. And then there is systematic sampling. It is, so in systematic sampling, it is a like technique for creating a random sample with each piece of data is chosen at a fixed interval. So it means that like every 10th data. Okay. So like if you're having a like 100 data or like 100 population, like we'll be taking like every 10th or 5th one. Okay. So like that's how systematic sampling works. And then there is stratified sampling. It means that it is made up of different layers or group of the organization. The sample size for each layer is proportional to the size of the layer and is token sampling with probability proportional. It means that here we will be having a different group. Okay. So let's say children. Okay. So let's say like children from the age of 0 to 15, and then people from 15 to 45, and then people from 45 to 60. So assume that in the population, the children from 0 to 15 of age is 60%, and 15 to 25 is 20%, and 45 to 60 is 20%. So in stratified sampling, we will be using the same proportion to get the sample. So from this 0 to 15 of child, like we will be selecting like 60% for the sampling. Alright, so that's how it works. So it is made up of different layers or group of the population. The sample size for each layer. Alright, so the sample size will be proportional to the size of the layer. Okay, so this is the size of the like layer of 0 to 15, and it is known as sampling with probability proportional to size. So it is based on the size, like we will make the sampling. And then there is multi-stage sampling. So it means that it is used when population is particularly large. Okay, so the multi-stage is used in case of large populations. Random sample is taken at each stage of population. Okay, so the random samples are taken at each population. But in like cluster is also a type of multi-stage. But we'll be taking the whole from the cluster. All right. So let's say in one level, like we have divided them into three level. All right. So this is 3 level. So in multi-stage, we'll be picking randomly from all of the group. But in cluster, like we'll be picking the whole group, and like everyone in the group will be like used for sampling. Okay, like that's what cluster sampling means. And then there is quota sampling. So quota sampling is like we will predetermine the group to be sampled. Okay, in this method, interviewer will be given a like list like comprising the like different level of people to be questioned and the number of quota of each type. So here, like it is already given that from children from 0 to 15, like 15 should be sampled, and 15 to 25, 20 should be sampled. From 45 to 60, 25 should be sampled. So like it will already be predetermined. That's what quota sampling means. And then there is this characteristics of big data we will be looking at. So here we'll be looking at the like what is big data. Okay, so big data is the large collection of data like that may be like analyzed to reveal patterns, trends, and association. Okay, so big data is like it is mainly used to get the patterns like or trend or associate like trend or association which is associated with some data something. So there are 5 V's of data. Okay, so it is 5 V's only, right? Okay, so the big data have very much volume and it can be of variety type, and it have some velocity means like the speed of getting data, it's too quick, and it have some value, and then veracity. Okay, so the big data can be of like different varieties. All right, and the risk associated. Okay, so the risk associated with the big data is that the availability of skill. All right, so the data analyst who don't know about how to process the big data is just waste. And next is security of data. Okay, so data can be get hacked, and valuable time is spending measuring relationship, but like it doesn't have any organization value. So we use big data to get like relationship like between some of the variable, but some variable may not actually have any relationship, so we are just so we will just be like wasting our time on that. And the next is incorrect data. Sometimes we can get some incorrect data, like, and then some like technical like difficulties, like interrupted power supply and all. And next is cost allocated with the big data. Okay, so like a large cost will be incurred in order to store the big data itself, because the big data should be stored in a huge database, so the cost allocated with like big data is also more. And the next is with analyzing data. Okay, so in like analyzing data, like there is nothing logical to think about, like you guys should like by heart the equation. So for arithmetic mean, the equation is x dash is equal to sigma x by n, and sigma x is the sum of values and n is the number of values. Okay, so that is mean. And for median, like it is used to get the like middle set of values when arranging in ascending order. Like so first we should like arrange in an ascending order, and then we should take the middle value. All right, so like if there is 6 like values, then you should take the average value. All right, and in mode, like the mode data will be the most repeated data. All right, so in order to get the mode of a data, they will be looking at the most frequently like repeated data, so that will be the mode. And then there is equation for standard deviation. So standard deviation will be the like difference from the mean. All right, so here will be consider like, so the equation for standard deviation will be sum of x minus x dash the whole square by n. All right, so this is the equation for, so this will be the like, so this will be the equation for like standard deviation and variance. Sorry, for standard deviation, like, so the equation will be square root of sigma x by like sigma x minus x dash the whole square by n. All right, so this will be the equation for standard deviation. And next is the variation. Okay, so the equation for variation will be the square of standard deviation. All right, like the square of standard deviation will be the equation for the variation that had occurred. And then there is coefficient of variation, and the equation for coefficient of variation is standard deviation by mean. All right, so the standard deviation will be this and divided by mean, or x dash. All right, and then there is expected value. Okay, like as you know that all value like is multiplied by the probability. All right, so the equation is sigma probability into values. And the equation for special distribution, it will be x minus mu by like standard deviation. Okay, so this gives the equation for special deviation. Okay, so you just need to like by heart this equation. All right, so in question like it will be directly given the values. Okay, so you like you just need to substitute that. All right, and then there is forecasting techniques. All right, how we can forecast for the future. Okay, so it is mainly used in budgeting. All right, so there are some forecasting techniques also that we'll be using. So the first will be the regression analysis. All right, and the equation for regression analysis is y is equal to a plus bx. Okay, so the y is the dependent variable, a is the intercept, b is the gradient, and x is the independent variable. And the like equation for b will be n into sigma x5 minus sigma x into sigma y like divided by n into sigma x square minus sigma x the whole square. Okay, so you just need to by heart this equation. All right, and n is the number of pairs of data, like how many pairs of data is provided. And the equation for a will be sigma like y by n minus b into sigma x by n. All right, so that's how we can get the like intercept of the like regression analysis. All right, and then there is correlation coefficient, and the equation for correlation coefficient is r is equal to n into sigma x5 minus sigma x into sigma y by square root of n into sigma x square minus sigma x into whole square into n into sigma y square minus sigma y the whole square. All right. So if the value of r is equal to 1, it means that it is a perfect positive correlation. Okay. So it means that the relation between like two variables are so strong. Like it's perfect. All right. Not strong, it's perfect. And if it is 0, like there is no relation, and if it is like -1, it means that it is perfect negative correlation. All right. And also, if the value of r is greater than positive, like greater than 0.8 or negative 0.8, it means there is a strong relation. All right. So it is not perfect, but it is strong if the value of r is greater than 0.8 or negative 0.8. All right. And then there is coefficient of determination. It represents the proportion of the total variation in the y variable that is explained by the regression equation. Like it means that how much change in y can be explained by the change in x. That's what called coefficient of determination, and the equation is r square. So if the r square is, let's say, 15%, the 50% change in y is because of x. That's what coefficient of determination gives. And then there is seasonal variations. All right. So the seasonal variation can be found using two models. All right, it's additive model and it's multiplicative model. So using additive model, we can get actual data by trend plus seasonal value. All right, sorry, the seasonal variation. So the trend will be provided in the question itself, and we can get seasonal variation by subtracting actual data from the trend. That's it. So that's what with additive model. And in multiplicative model, in order to get the actual data, the equation will be trend multiplied by the seasonal variation. This trend and seasonal variation will be like directly given in the questions in MA. All right. So you just need to like multiply and get the actual data. That's it. And then we'll be looking at the moving averages. So it is the series of averages calculated from historical time series data to get the trend. So the moving averages is like mainly used to get the trend associated and also the variations. All right. And then there is index number. So index number is used to comparing changes in some features of group of item. Like let's say inflation. Okay. So there is this price index. Okay. So let's say, so the price index in like year 1 would be 100. And the price index in like year 2 will be like let's say 125, means that the like comparing to the previous year, like this year's price is 25% more. Okay. So this is what price index means. And then there is simple index numbers. It is the like measure that changes either the price or quantity of the single item. Okay. So by using like simple index equation, so we can get the like price index comparing two prices. All right. So the equation will be P1 divided by P0 into 100. Here the P1 will be the price at the time 1. Okay. So here P1 can be considered as the like price at year 2. So it's how much? 125. And the price at time 0 will be the price at year 1. It's 100. And like into 100 give the like price index. Like how much it would be? It would be 1.25. So this would be the price index. So it means that the price when comparing to the previous year is 25% more in this year. And then there is chain base index number. It expresses each year's value as a percentage value of previous year. So here will be given the like price index of, let's say, year 1, 2, 3, 4 and all. Okay. So in chain base like index number, for year 2 we will be considering the price index of year 2 with year 1. For year 3 it will be compared with the year 2. So that's what chain base index number means. So the equation will be the index value of this year or the price value of this year divided by last year's value into 100. So this gives the chain base index. All right. And then there is multi-time index numbers. Okay. It gives the overall change. Okay. Here we had only consider either the change in price or quantity. In multi-item index numbers, we will be considering the change in overall price and overall quantity. All right. When compared to the base year. All right. So here we'll be getting a single index. Here we'll be getting a single index which contains the adjustment of both price index and quantity index. Okay. So the steps is, first calculate simple price of each item. Okay. Or the simple price index of each item. So then we should get the overall price index. Like it will be by like comparing current year index divided by base year. That's it. And then calculate simple quantity index. same as price index, get the quantity index, and then this quantity indices must be like weighed in like some of the suitable manner in the order to produce an overall quantity index. So uh, the default basis we use is based on quantity. All right. So based on quantity is the main measure, so which we use to get the multi-item index numbers. All right. So so that is the like suitable manner where we can get this indices by considering both price and this quantity. All right. And next is the index numbers. All right. So here we'll be considering like two types of like index numbers. It was like by last pair is index numbers and also Pash is index numbers. So the equations of last pair is like index numbers is that current year's price into base year quantity and divided by base year price into base year quantity into 100. So the equation will be P1 Q0 divided by P0 Q0 into 100 also. Okay, so you just need to like by heart this equation, and for like quantity index will be Q1 P0 divided by Q0 P0. All right, so this is equation for like quantity index according to last pair index numbers. And then there is Pashi index numbers. So the equation for Pashi like index numbers is current year price into current year quantity. All right, it's P1 Q1 like divided by base year price P0, current year quantity, it's Q1. All right, so the equation will be P1 Q1 divided by P0 Q1 into 100. So this is the equation for price index. And for quantity index, it would be current year quantity Q1, current year price P1, and then base year quantity Q0, and then current year price P1. Okay, so this is the equation for quantity index. Okay, so you just need to like revise this equation. All right, and then we'll be looking at the budgeting. So every company will be preparing their budget for the next year, right, for the next financial year. So what's the purpose of budgeting? So the purpose of budgeting is mainly to plan for the future. Like the company will be planning like how the next year's performance will be, or like what are the plans they are looking into for the upcoming year. So it's like mainly for planning for the future and then for controlling cost. Okay, if the company prepares budget and give it to the production department, then they know that how much cost should they incur for their production. Okay, so it will help to control the cost and it will help in coordination. All right, like coordination between different departments and also the communication. By giving the budget to the different department, like we are communicating how you should work. Okay, like how you should perform in this year, like how you're expected to work. That's all. And then there is motivation. So without the budget, the department don't know how they should work or how should they perform. So they will not have any motivation to work because they are not given any target. But by giving at the budget, the company is giving a target to the employees, so they'll be motivated to work to reach the budget, and to achieve the budget, like they'll be given some incentives or bonus or something. Okay, so they'll be like motivated to work to reach that budget. And then there is evaluation. So by using budgeting, we can compare the actual performance with the budgeted performance. So the preparation of budget will help in the evaluation of the performance of the company in that particular financial year. All right, and then there is authorization. All right, so the preparation of budget will also give like authorization like in the different managerial levels. Okay, and then we're looking at approaches to budgeting, how we can prepare budget. So the budget will be mainly prepared using two types. It will be top down and bottom up. So the so what's top down and bottom up is all like is already explained in the ArivuPro ACCA like YouTube channel by two faculties, and one is me. All right, so like I'll just explain that. So in top down budgeting, all right, in top down budgeting, the upper level management will be preparing the budget and it will be given to the lower level management. Okay, so the upper level management will be like preparing that and will be given to the lower level management to perform that. Okay, so like it will affect the motivation of the lower level management. All right, so like in that case, the opinions of the lower level management is not considered. All right, so they will not be like motivated by using the top down approach. And in bottom up, the budget is set with including all budget holders on setting their budget. Okay, so in bottom up, we'll be asking the opinions of the lower level managers on how can they perform, how the budget should be, and after that only the budget will be prepared. That's what bottom approach means. All right, so like it will give a like motivation for the employees to perform and achieve their targets. because they are the like they are the ones setting their own targets. All right. So that's with top down and bottom up approach. All right. And then there is incentive schemes. How the company should pay incentives to their workers. What are the incentive scheme that the company should look into? All right. So budget by themselves have a limited motivational effect. Okay. No employee will be motivated to work to the budget like if they are giving like nothing on achieving them. Okay. So it is the reward structure that is linked to achieving the budget requirement. Okay. So if a reward structure is made, then the employees will be motivated to achieve the budget and to get the reward. So it provides the real underlying motivation potential for budget. All right. So this so like by giving the reward structure, like it will provide the real underlying motivation potential for budget. All right. So by giving the reward, the like the employees will be motivated to achieve the budget. Okay. And the characteristics of good employee reward system. Okay. So if a company had like made a reward system for employees, these are the characteristics to know that if they are good or not, if the reward system is good or not. First, it should be fair. All right. So we should consider the effort of everyone. Okay. So the partiality should not be there in reward system, and then it should be motivational. It means the criteria that we are giving for the employees to meet should be aligned with the budget, and it should be motivational. All right. So like the target should be achievable. All right. So don't give them a like by giving them a target which is beyond achievable level, then they will not be motivated to achieve that. So it should be motivational. All right. And next it should be understandable. Each employee should give a clear cut idea on what should they do. Okay. Clear to employees on what should they do. So that's the third thing, and it is consistently applied. Okay. Same way for all employees. So like every employee should be given the same thing, like same like not the same criteria, but the same basis of measurement on their performance. And there is objective. The reward system should be based on measurable criteria. All right. So if the company is saying to the sales department that you just make the sales, I will give you the reward. That's the first case. And the next case is if you achieve a reward. If you achieve a revenue worth like $1 million, I'll give you a bonus. Okay. So is the first one or second one will be more understandable or achievable to the employee, or like meeting the objective? The second one only, because in that the employee is given their objective. The objective is $1 million of revenue. First case, you just make the revenue, I'll give the bonus. Okay. So in that case, the objective is not met. But in the second case, the employees know what to do to get the reward. So that's what objective means. And next is universal. All employees and managers should be subjected to appraisal and rewards. Okay. It means that the all managers, I mean all managers and employees in a company should be subjected to the appraisal and rewards. Okay. So you can't exclude someone from that. All right. And there are three basis in which the incentives are paid. The first one is performance related pay. Okay. So if an employee is performing well, then he will be given a more pay and that all. So let's say this differential piecework system. It's a kind of performance related pay. And then there is bonus schemes. It means that each year, or on completion of the 1 year, the employee will be given a bonus or something. So that's what bonus schemes mean. And then there is profit sharing. Okay. If the company achieve this much profit, 20% will be given to all of the employees and managers. Okay. So these are the three types of incentive schemes. And then there is the functional budget. It means for all department which is functioning, there will be a budget. All right. So the main functional budgets are sales budget, production budget, raw material budget, usage budget, then purchase budget, then labor budget, and overhead budget. So these are the main functional budget that is prepared by the company and which is given to the respective department to achieve, right? So the equation for production budget will be the forecasted sales. All right. Forecasted sales minus opening inventory finished goods plus closing inventory. Okay. It's not minus, it's plus closing inventory. Okay. So the equation will be forecasted sales minus opening inventory finished goods plus closing inventory gives the production budget. And for material budget, it will be how much material will be using. Okay. Forecast material usage minus opening inventory plus closing inventory. All right. So this gives the equation for material budget. Okay, so like these are the like equation associated with the production budget and material budget inventory. Okay, all right. And then there is budgetary control. I mean, the purpose of budget will become complete if we are having control over the budget, or how it is valuated, how the budget is compared with the actual performance. All right. So here there are two types of control: feedback and feed forward control. So in feedback control, it is a comparison of budget with actual performance with a view of revising plans. All right. So in that case, after completing the year, we will be comparing it with the actual performance, and on the basis of that, like the changes will be made next year for budgets and operations. All right. So this will take place after the event only. It means after completion of the performance only feedback is made. But in feed forward, it's already planned. It means that in year start, we will prepare a budget. In year start, we will prepare a budget. And after 3 months, we will be looking at the budget. And like if we saw any like deviation from that, for the next 9 months, we'll be revising the budget. That's what feed forward means. It means like before happening that, like we are changing the budget. That's what feed forward means. So it gives a like feedback like before it is happening. Like that's what feed forward means. And then there is like different types of budgets, which are fixed budget, flexible, and fixed budget and flexible budget. So the fixed budget is a budget produced for a single level of activity. Okay, and it does not change with the volume of production. All right. So fixed budget is just fixed. So like if you are making budget for 1000 unit, so that is fixed budget. But for flexible is one which by recognizing cost behavioral patterns is designed to change as volume of activity changes. All right. So flexible budget means that we can change with the level of activity. Okay. For 1000 unit, this budget. For 2000, this budget. For 3000, like this budget. For 4000, this budget. Like that. So we can change the budget according to the level of activity. That's called flexible budget. All right. And then there is controllable cost and revenues. So the controllable cost and revenues are those cost and revenues which result from decisions within the authorities of a particular management unit. It means that if a manager has a if a manager have a control over something, it means like the control over like control over their cost and revenues. Like then those cost and revenues are called controllable cost and revenues. It is the cost and revenues which can be controlled by that particular manager. If a manager can control that, then it is called the controllable cost and revenues of that manager. And the rest will be considered as uncontrollable cost. Okay. So the cost which is beyond the control of the manager, that is uncontrollable cost. And if the cost can be if the cost can be controlled by the manager, it is called controllable cost and revenues. All right. So that's with budgeting. Next we'll be looking at capital budgeting. All right. Let me look how many portions we have. Okay. Let me drink some water. Okay. So capital budgeting. So first let's look at the definition for capital investment. So when a business spend money on a new non-current asset, it is known as capital investment. Buying new machines, new building, or other new assets, it's called capital investment. All right. So what are the stages involved in capital budgeting? So the first is we will forecast our capital requirements. It means that what all we require for capital, first we will identify that. Then identify suitable project. How can we satisfy that requirement? Then there is appraise potential object. Okay, so there are different appraisal methods. By using those methods, we will appraise the project, and then there is select and approve the best alternative. By comparing the different alternative, we will select the best one. Okay, and the next we will make the capital expenditure. So we will by paying the cash, and then we will compare actual and planned spending and investigate deviation and monitor benefits from the project over time. Okay, so after making the capital investment, we will oversee or we will monitor the performance of that capital investment made, and we will assess the benefit that we get from that. All right. So in capital investment appraisal, it is more appropriate to evaluate using future cash flows rather than accounting profit. Okay, so in order to appraise a capital investment, we will be looking at the future cash flows rather than accounting profit. Okay, so the cash flows that we include should be relevant. All right, so in order to consider some cash flows during appraisal process, those cash flows should be relevant, and in order for a cash flows to be relevant, it should be future. Okay, it should be happening in the future, and it should be actual cash flows. All right, it shouldn't be this depreciation, amortization and all. It should be actual cash flows, and it should be incremental cost and revenues. It means that if I take the decision, then the cash flow will occur. Only that type. Okay, so even if I don't take the decision, then also if the cash flows occurs, it is not relevant to the decision. All right. So the terms which are included in the relevant cost. First is differential cost. It is the difference between total cost and revenues between alternatives. So if I take this cost and this cost and revenue, and if I take another cost and revenue, so the difference between this gives the differential cost. And then there is opportunity cost. So opportunity cost is the best alternative foregone as a result of making the decision. Okay, so if I take one decision, I'm losing another best one. That's what opportunity cost means. Next is avoidable cost. Those are specific costs that can be avoided if the investment is not made. Okay, so even if I don't make the investment, I can avoid some cost. That is also relevant to the decision. And then there is terms in terms which are not relevant, the terms which are considered as irrelevant cost. All right, the first one is sunk cost. So if we already pay the cost, it is sunk cost. It is past or historical cost. And then there is committed cost. Okay, so the committed cost is future cost. So we may think that it is relevant, but that cannot be avoided. Okay, so if a future cost which cannot be avoided, it is considered as a committed cost, and it is irrelevant. Okay, so even if we don't make the investment, we should pay for the cost. It is called committed cost. So it is irrelevant to the decision. And then there is no cash flow cost, such as depreciation and all. And then there is general fixed overhead. Okay, so the general fixed overhead will incur even if I make or do not make the investment. So it is irrelevant. And then there is carry amount of non-current asset. It is also irrelevant because the carry amount is get from deducting cost, which is a sunk cost from the depreciation, which is not an actual cash flow. So the carry amount of non-current asset is also not included in the is also not included as the relevant cost. All right. And then there is time value of money. All right. It means that the money that we get now is worth more than the money we get in the future. It means that the 100 rupees worth now is different from the 100 rupees worth after 20 years, right? Because of the inflation. That's what time value of money is. The money received today will be worth more than the same amount received in the future. That's what time value of money means. All right. And then there is simple interest and compound interest. All right. So the simple interest means investment made for less than a year. Okay, if we are making the investment for less than a year, it is simple interest, and the equation will be x plus x into r into n. So v is the future value, x is the initial investment, r is the interest rate, n is the number of time period. So this is the equation for simple interest. And then there is compound interest. It is when we are making investment for a number of years. It means if you are making investment for more than 1 year, then we will be calculating the compound interest, and equation will be v is equal to x into 1 plus r the whole raised to n. V is the future value, X will be the initial investment, R will be the interest rate, and N will be the number of time period. It means for how much years we are investing. It can be 2 years, 3 years, 5 years, 10 years, or what. Okay, so that gives the compound interest value. And next is the nominal interest rate. So the nominal interest rate is the stated interest rate for a time period for a month or an year. Alright. So if we are saying 12% per year, it is a nominal interest rate. Or if we are saying 10% per month, it is also a nominal interest rate. Then we will be looking at the effective interest rate. Alright, the effective interest rate. So it is the rate that include effects of compounding a nominal interest rate. So this 12% is getting for 1 year and I am investing for 3 years. So I should get how much is the total returns I am getting from this investment. It is called effective interest rate. So the equation of effective interest rate will be 1 plus I by n the whole raised to n minus 1. Here R is the effective interest rate, I is the nominal interest rate, and n is the number of time period. Okay, so this equation gives the effective interest rate. Alright. So this is the equation for that. Try to screenshot and perform it after the marathon. Okay. And then there is discounting. So discounting is the present value of amount that would be received in the future is calculated. It means I'll be getting some $300 in 3 years. Okay, so in the 3rd year I'll be getting $300. So I should get the value of the $300 for now. Okay, so what is the current value of that $300? So it will probably be less, right? So in order to get that, we'll be using discount factor, and the equation for discount factor is 1 divided by 1 plus r the whole raised to n. But this will be provided in the exam, right? It will be provided as a discount table. Okay, so the discount table will be provided in the exam actually. So don't, okay, so just know the equation. That's it. All right. Either way, it will be provided in the exam as table. So here R is interest rate and N is the number of time period. Okay, and next we'll be looking at the different appraisal method. So for capital budgeting, we'll be appraising different projects. So we can use either of these method, in order to appraise those projects. Okay, so the first is the payback period, then it is net present value, then it is internal rate of return. All right. So the payback period, it is the time a project will take to pay back the money that is spent on it. So the equation will be initial investment divided by annual cash inflows. And in case of uneven cash flows, okay, sometimes in different year, different cash flows can happen. In that case, the cash inflows are deducted from the initial investment till the cumulative cash flows reaches 0. All right, so that's how we will get the payback period if the cash flows are not even. Okay, if in different years, if different cash flows are taking, then we will be considering this only. All right, so we will be deducting the initial investment. So if the initial investment is 100, so we'll be adding the income. So let's say, so the first year it is 10, then it is 50, then it is 40. So that's why we will get the 0. So the payback period will be 3 years. So by adding this inflows to the outflows, we will get the payback period. All right, and so then there is discount payback period. Okay, so in payback period, we didn't consider as the time value of money. All right, so this will be getting in the first year, and this is not second, and this is not third. All right, so we didn't consider the time value of money in the payback period. So in order to consider time value of money, also we will be considering the payback period. In discounted payback period. So in discounted payback period, the cash flows are first discounted using cost of capital, and then the cumulative cash flows are considered. So after discounting, we will do the exact process to get the payback period. All right, so that's with payback period. And next we'll be looking at the net present value. All right, so the net present value represent the net benefit or loss in the present value of terms. All right, so in that also, in NPV also, we'll be considering the whole life of the project, and we will discount every cash flows, and we will get the net value. It means deducting outflows from the inflows, we will get a value, and it gives the profitable value from those investment. All right, so it represents the net benefit or loss in present value of terms. If an NPV is positive, it represent we can get surplus funds other than cost from the investment. All right, so if the NPV is positive, then the project will be viable. All right, and here the cash inflows or outflows are discounted. and the net amount is calculated to check if investment is viable or not. It means the equation for NPV will be present value of inflows minus present value of outflows. And if the present value of inflows minus present value of outflows is positive, then the NPV, then the investment is viable. And if it is negative, the investment is not. It's loss making. All right. And then the advantages. So the NPV considers the time value of money. It measures absolute profitability, not the relative. Okay. So it gives the absolute value, and it considers cash flow. It considers the whole life. It considers the whole life of the project. And if we select NPV, so if we appraise the project on the basis of NPV, it will increase the shareholders' wealth. And but the thing is that it is fairly complex, because the estimation of future cash flows is a different, is a difficult task. Okay, now we are expecting the cash flows in the future. It's not so easy to make, and then not well understood by non-financial managers. Some of the managers who are not involved in the financial field may not understand what NPV means, and then it is difficult to determine the cost of capital. Okay, so the cost of capital will include the risk and all other things associated. So it is difficult to determine the cost of capital also for the to appraise the investment. And then there is internal rate of return. So it is a percentage at which the NPV would be 0. All right. So the IRR gives the percentage or the cost of capital at which the NPV is 0, and the equation is L plus NL divided by NL minus NH into H minus L. All right. So here L is the lower rate of interest, H is the higher rate of interest, and NL is the NPV at lower rate of interest, and NH is the NPV at higher rate of interest. Okay, so this should be by hearted. Alright, so first you should get the NPV at two different cost of capital. Alright, so in order to do this equation, you should get NPV at two different cost of capital, and after that you should substitute that in this equation. Alright. And advantages is that it considers time value of money. It considers the time value of money, and the percentage would be understood by the non-financial managers also, and it also considers cash flow, and it can be calculated without the cost of capital. So the measurement of cost of capital is not so necessary. And if the company select the investment based on IRR also, it will increase the shareholders' wealth. And the disadvantages is that it is not a measure of absolute profitability. It only gives a relative measure, not the absolute amount. And interpolation only provides an estimation of the true IRR. Okay, so we should be supposed to make further thing other than the IRR calculation to get the absolute IRR, and it is fairly complex to calculate, obviously. And the IRR project may conflict the NPV. It means that sometimes the NPV can be negative. Still the on the basis of IRR, it may be viable. Okay. Sometimes, so there may be clash between the NPV and IRR. All right. And it is possible for non-conventional cash flows to have multiple IRR. Okay. So if the cash flows can be different, then the different IRR can arise also. Okay. So it will affect the decision that we are making. So in that case, sensitivity analysis should be made. Okay. And then there is annuity and perpetuity. Okay, so annuity is the constant annual cash flow for number of years. Okay, so if you are getting $100 for 10 years, then we'll be looking at the annuity factor. All right, so we'll be in order to get the present value of $100 for 10 years, the equation will be annual cash flow 100 into annuity factor, and the equation for annuity factor is 1 minus 1 plus r, the whole raised to minus n by r, but it will be provided in exam. All right, in exam an annuity table an annuity table will be provided. Okay, so you are not required to do this equation actually, but just know the equation, that's it. And then there is perpetuity. It means this $100 is getting for infinite period. It's forever. It's for lifetime. It is getting. Then the present value will be cash flow divided by R. All right, and R will be the interest rate. All right, and the IRR will be annual inflow divided by initial investment into 100. So this gives the IRR. All right, that's it. So that's with capital budgeting. Okay, so then we'll be looking at the standard costing. All right, standard costing is with these equations and all. Then there is performance measurement, balance scorecard. So much. So next we can start with standard costing. Okay. So in standard costing, first you should know about the type of standards that we are making. Okay. So first there is basic standard. So these are long-term standards that will remain unchanged over a period of years. All right. So that's what basic standard means. And there is ideal standard. It is on perfect operating condition. Like it means that 100% efficiency or 200% efficiency. Like it means that like there is no room for mistakes or something. All right. Like it is based on perfect operation or like operating the condition which is impossible to achieve actually. Okay, so like it may have adverse motivational impact. Okay, so if the standards are set at like if the standards are set at an like ideal level, it will be difficult to achieve or it is not possible to achieve. So that's what ideal standard means. And attainable means it is more frequently used. Okay, it is based on efficient operating condition. It means that like you don't have to be perfect, you just have to be efficient. All right. So if the company prepare budget based on 100% perfection, it is ideal standard. But if it is based on let's say 98 or let's say like 95 to 98% perfection, all right, 95 98% perfection, it is attainable standard. It means that like, we can achieve that. Okay, like it is not impossible to achieve that. That's it. And then there is current standard. Like it is based on current level of efficiency. All right, it means how we are working now, just go like that. All right, so in that case like there so like in that case like there will not like there will not be any motivation to improve, right? So that's what current standard means. It is based on current level of efficiency. It does not provide any incentive to improve. We will be go they will be going as how we are going now. All right, like there will not be any changes made in that. That's what current standard means. And then we'll be looking at the different types of variance analysis. All right, so we have sales variance, material variance, labor variance, variable like variable overhead variance and fixed overhead variance. So first is the sales variance. So basically there are two types of like sales variance, which is sales volume variance and sales price variance. So the equations of sales volume variance is actual quantity sold minus budgeted quantity into standard margin. And the standard margin depends on the costing method. If the company is using marginal costing, then the standard margin will be contribution per unit. If the company is using absorption costing, then the standard margin will be profit per unit. And for price variance, it will be actual price minus budgeted price into actual quantity sold. Okay, so this is the equation for price variance. Actual price is compared to budgeted price into actual quantity sold. And then there is material cost variance. All right, so in material cost variance also like there are two types of method. All right, so like either we'll be like doing this method, I mean AQ into AP, AQ into SP, SQ into SP. All right, so like either you can do this equation and like by comparing this we will get price variance, and by comparing this like we will be getting usage variance. Okay, so maybe you had studied this method. Okay, so you can use either of this method to get the variance answer. Okay, so like I had prepared according to this method only. Okay, so the equation for material price variance will be actual price minus standard price into actual quantity, and for usage it will be standard quantity minus actual quantity into standard price. All right, and then there is labor cost variance. So the equation for cost variance will be, sorry, like in cost variance also there are two types. So labor also there are two types of variance. It's rate and efficiency. So the equations of rate variance is actual rate minus standard rate into, sorry, it's standard rate. Okay, actual rate minus standard rate into actual hours, and the efficiency variance will be actual hours minus standard hours into standard rate. Okay, that's it. And then we'll be looking at variable overhead variance. Okay, so the variable overhead variance is same as labor cost variance. It's almost same. Okay, so the equation for rate variance is used in expenditure variance. Actual rate minus standard rate of price, sorry, actual rate minus standard rate into actual hours. It is same as this equation only. And then there is And then there is efficiency variance, which is actual hours minus standard hours into standard rate. Like it is same as this equation only. All right. So the equation for variable overhead variance and labor cost variance is almost same. All right. And fixed overhead variance can be different based on different accounting system. All right. If we are using marginal system, okay. If we are using the marginal system, then we are not apportioning overheads to each unit. So there will not be absorption of overhead. Okay. So if the company is using marginal system, then there will only be one variance. All right. If the company is using marginal system, then there will only be one variance, and it is fixed overhead expenditure variance. The equation will be actual expenditure minus budgeted expenditure. Okay. So only this equation will be there if the company is using marginal system for fixed overhead variance, only fixed overhead expenditure variance, because we will be comparing the actual cost with the budget. Like we are not allocating them. But if the company is using absorption costing system, all right, if the company is using absorption costing system, like there can be two variances. It is fixed overhead expenditure variance and fixed overhead volume variance, and there are two equations for volume variance. All right. So if the company is using absorption system, there can be two variances. It's expenditure variance and volume variance. So the expenditure variance equation will be same. It is actual expenditure minus budget expenditure. And for volume variance, it will be either actual unit into FOIR. If the absorption is made based on unit, then the first equation is used. It actually unit into FOIR minus budgeted expenditure. It gives fixed overhead volume variance. Then, like if you are apportioning based on the hours, then the equation will be standard hours for actual production into FOIR per standard hour minus budget expenditure. Okay, so if the company is using like unit, then the FOIR will be FOIR per unit. Okay, and if the company is using hours, it will be standard hours for actual production into FOIR per standard hour minus budget expenditure. And this, if the company is using standard hours, or like if the company is absorbing based on hours, then we can further break the volume variance into capacity variance and efficiency variance. All right. If and only if the company is using hours for the absorption, then we can use like further variance such as capacity variance and efficiency variance. And the equation for capacity variance will be actual hours into FOIR per hour minus budgeted hours into budgeted expenditure. All right. So the actual hours into FOIR per hour minus budgeted expenditure gives the capacity variance. And for efficiency, it will be standard hours for actual production into FOIR minus actual hours into FOIR. All right. So this gives the efficiency variance. All right. So the variance equation, all the variance equation, like you are required to by heart. All right. Just by heart this equation and apply in the exam. That's it. All right. And next we'll be looking at the operating statement. So as we know that variance is the difference between budget and the actual. There will be difference between budgeted profit and actual profit also. So in order to show the difference between budgeted profit and actual profit, we will be using operating statement. Okay. So the operating statement, so in the operating statement, all right. So consider this as the operating statement. The first will be the budgeted profit or contribution. All right. In operating statement, the first one will be the budgeted profit or contribution, and the last one will be the actual profit or contribution. All right. And here will be the variance. All right. So if standard starts with budgeted profit or budgeted contribution, then all the favorable variance will be added. As the favorable variance increases, the profit from budget, it will be added, and the adverse variance will be subtracted. If we are starting from budgeted profit, and after doing this, we will be getting actual profit or contribution. And if we are starting from actual profit, okay, if we are starting from the actual profit, okay, so here to reach actual profit or contribution, right? And if we are starting from the actual profit or actual contribution, then we will be deducting the favorable variance and adding the adverse variance. Okay, so it is the reversal. Okay, so when we are starting from the budget, the favorable is added and the adverse is deducted. But but if we are starting from the budget profit or contribution, we will be deducting the favorable variance and adding the adverse variance, like just the reversal of the previous one. All right. So by subtracting the favorable variance and adding the adverse variance, we will get the we'll be getting the budgeted profit or contribution. All right, so that's how operating system works. All right, so next we'll be looking at the performance measurement. All right, so to assess the performance of the company, you may have studied this in FA and all. Okay, so there are three types of ratios. Let's say profitability, liquidity, and gearing. So the profitability ratios are gross profit margin. Equation is gross profit by sales, operating profit margin, and ROC, return on capital employed, asset turnover, and the equation for capital employed is total asset minus current liabilities, or non-current liability plus total equity. All right, and then there is inventory holding period, inventory by cost of sales in 365, receivable collection period, receivables by credit sales in 365, and payables period, payable by credit purchase in 365. Okay, so these are the equation that you should note down and by heart. All right, so I'm just revising this equation, that's it. And then there is liquidity ratio. Okay, so liquidity ratio, the current ratio will be current asset divided by current liabilities, and for quick ratio it will be current asset minus inventory divided by current liabilities. All right, and then there is gearing ratio. So the gearing ratio is associated with the risk associated. Okay, so we are having operating gearing. So the equation for operating gearing will be fixed cost divided by variable cost, or a fixed cost divided by total cost. Either one can be. And for financial gearing, it will be debt by equity, or debt divided by debt plus equity. And for interest cover, it means how much time the interest can be paid according to your current profit. It will be operating profit divided by PBIT. Divided by finance cost. The operating profit is the profit before interest and tax. This is the operating profit. And there is dividend cover. It means how much time we can pay the dividend. It is net profit divided by dividend. Okay. And then there is, so this performance measurement is used to assess the total performance of the company. Okay, the total performance of the company can be assessed using these ratios. But in order to get that divisional performance, we'll be looking at the return on investment. All right, so the equation will be controllable profit. It means the profit which is made by the controllable cost and revenues of the particular division divided by capital employed on the division into 100. So the advantage is that the ROI is widely used and accepted since it is aligned with ROC. The ROI is same as ROC. It is comparing profit with the capital employed, and then it is a relative measure so that we can compare between divisions of different sizes, and it can be broken down into profit margin as a turnover also. All right. So it can be broken down into profit margin as a turnover also for calculation. And the disadvantage is that it may lead to dysfunctional decision making. Sometimes the ROI is not reliable. All right, and ROI increases with the age of the asset. It means that when the age of the asset increases, the depreciation increases, and if the depreciation increases, then the carry value decreases. So in that case, the capital employed will decrease. All right, if asset value decreases, then the capital employed decreases, and if the capital employed decreases, then the ROI will increase. So some management will hesitate to make further investment, as that may affect their ROI, because if I purchase new asset, then the capital employed will increase, so that will decrease the ROI. Okay, so in that case, some manager may hesitate to make further investment. Okay, and then it is it may lead to manipulation of profits and assets, obviously, and different accounting policies also affect. So if one company is using reducing balance and other is using straight line, there can be difference in the comparisons also. So since ROI is a relative measure, there is another equation introduced to get the actual measure on investment, and it is called ROI, or residual income, and the equation will be controllable profit minus notional interest on capital. Okay, don't worry, the both will be given in the question. The controllable profit and the interest on capital will be provided. Okay, so then the interest on capital will be provided as the asset value will be provided. Okay, let's say the asset value is 100 million and the interest on capital is 10%. Okay, so then we should multiply the 100 with the 10%, which gives the 10 million will be the notional interest on capital. And the advantage is that it encourages investor managers to make new investments, obviously, because if RI increases, RI only increases with further investment, so the like so like it encourages investment like for the central management to increase the residual income. All right, and it like making specific charge on interest help to make new investment to central managers and more aware of cost of asset. So if a cost of capital is more, like it indicate that like it is more expensive for that asset to work on. So like it will give a like better insight on cost. And then risk can be incorporated into interest rate used. Obviously, like the cost of capital will also incorporate the risk associated with the investment. And the like disadvantage and the disadvantage is that it does not facilitate the comparison between two different sizes. Okay, like if one company is only this much and one company is this much, like obviously the RI of this company is less and the RI of this company is more. All right, so it does not facilitate the comparison between two like two division of different sizes, and based on profit and capital employed manipulation, since it also include profit and capital employed, it can be get manipulated. All right, and then we'll be looking at the balance scorecard. Okay, so this balance scorecard is not so important in MA actually, like it is like tested in the PM paper, the advance of MA. So like, but I will just read through it. All right, so here we will be evaluating company based on 4 perspective: customer perspective, internal business perspective, innovation and learning, financial. So in customers perspective, we'll be thinking from new and existing customers value, and in internal businesses, what process should be excelled for financial and customer objective. So like in order to meet the financial and customer objective, like what should be done. And like innovation is planning for the future. I mean, how the company is planning for the future. Okay, so like the company like is assessed from like that perspective also. All right, and then there is financial perspective. It means how the company is creating value to the shareholders. All right, so the company will be like evaluated using this 4 perspective, and the benefit is that it focus on factors which also include the non-financial factors. Okay, so this will enable the company to succeed in long term. All right, some companies may only be focused on profit, but focusing on profit may affect the goodwill of the company. But using the balance scorecard, the company will be focusing on the like non-financial perspectives such as customer perspective and innovation. So by using this method, like we are planning for the future, we are getting the future aspect on the company. All right, so we can get a like, clear image on how the company should work and like and how it would create value over time. And then it provides external as well as internal information. All right, so since we are considering the customer perspective, it is external to the company. So like here we are considering internal as well as external perspective. And the problem is that some performance measure can be difficult to perform. Obtaining information can be difficult. Information overload. Like we'll be getting like huge amount of information, like so we don't know how to process that or what to do with that. And conflict between measures. Okay, some measures can be contradicting. Okay, so that is also a like limitation of this balance scorecard. All right, and next is performance measurement in a non-for-profit organization public sector. As you know that since most of the profit making companies are focused on profit, the company's performance can be assessed using the profit achieved by them. But if a company is a non-profit organization, like they don't want profit, all right, like they are working for service, then we can't assess them on the basis of profit they are making. All right, so the main aim of non-for-profit sector will be will not be to maximize profit. They will be having some non-quantifiable objectives which is subjective to each non-profit organization. It means that each not-for-profit organization will be having different aims to achieve other than profit. Okay, and it will be different based on the type of sectors also. Okay, so this will result in difficulties to assess the performance of a non-for-profit organization since they are not focused on profit. We can't use profitability ratios on them. All right, because they don't want profit, so they will be having multiple objective to meet. So sorry, like the multiple objective to meet. All right, so the non-profit organization will not be focused on profit, so we can't measure them on the basis of profit. We should make a performance measurement which is subjective to each of the non-profit organization based on their objective. Each company will have different objective. So we should make performance measurement like the performance measurement assessment like based on their requirement. All right. So what are the problem with multiple objective? So in here, most objectives will be very difficult to quantify, right? As they are not focused on profit, some of the objective will be like difficult to quantify, especially in financial terms. All right. So hospital is like mainly focused on providing services to patients or the free services to patient. So sometimes it will be difficult to quantify that or like present it in monetary terms. All right. Another is multiple and conflicting objective may arise. Okay. So the one objective of hospital will be to provide like medicine at low cost. All right. And the other objective will be other will be to provide free medicine. All right. So the company want to get this medicine at low cost and also want to provide free medicine. So like obviously the cost will increase. All right. So sometimes there can be multiple and conflicting objectives like between the objectives of non-for-profit organization. So the main performance measurement which is used for non-for-profit organization is the value for money. All right. These are the three factors which can be mainly used to get the performance of the non-for-profit organization. The first one is economy. It is an input measure. So here we will be looking at the resources which are available at cheapest with required quality. It means that we need the resources, but it should be cheap and also the required quantity should be met. So where we are getting the item at the cheapest price with the with the considerable quality, then our economy is achieved. Okay, so it is mainly based on cost cutting. And next is efficiency. It is the input linked with the output. I mean, how much input is made, how much output is produced. All right. So a hospital will be having 4 doctors only, but their performance is measured like not based on the amount we are getting from treating. Okay. In efficiency, we will be looking at the doctor's performance on curing the patient. I mean, how much patients had been recovered or like how much patient had been treated by the doctor. Like that's what efficiency means. It is input linked with the output. Input is the consultation provided. Output is the how much patient got their consultation. So it is the output achieved from the input made. That's what efficiency means. And effectiveness is output compared with objectives to know whether they are met or not. It means that the main objective of a hospital is to cure the disease of a patient. So if we are getting a doctor with a lower salary, then the economy is met. So the economy is met over. And if that doctor had treat 10 patients in a day, okay, then he is efficient. He can treat 10 patients in a day. Okay, like each doctor, each doctor can treat 10 patients in a day, then he is efficient. Also, out of the 10 patients he had treated, 9 patient or 10 patient completely had got their diseases cured, then then his consultation is effective. All right. So if a hospital is working in such a way, if a government hospital is working in such a way, then we can say that the hospital is performing well. Okay, getting the doctor getting the doctor with an some experience with a lower cost, economy is met, and the doctor had managed to treat maximum number of patients in a day, then he is efficient. Also, out of the patient he had treated, he had managed to cure the disease of most of the patient, then then his consultation is effective. All right, this is what value for money means. That's how the performance of non-for-profit organization is considered. Okay, for different this will be different actually. Okay, for transportation, there may be different objectives and all. Okay, so this is how we can measure economy, efficiency and effectiveness from the example of a hospital. I hope you got clear about that. And then we have the equation for economy, efficiency and effectiveness. If you are producing a unit or something, In order to get the economy, the equation will be standard output divided by actual input into 100. All right, and in order to get the efficiency, it will be actual output divided by actual input into 100. And for effectiveness, it will be actual output divided by standard output into 100. All right, so first will be based on, okay, well, I think it is based on like standard input only. All right, so the equation for economy will be standard input divided by actual input into 100, and efficiency will be actual output divided by actual input into 100, and effectiveness will be actual output divided by standard output into 100. Okay, so this equation is just need to like know about it. That's it. All right, so the equation is not so important, because in non-for-profit organization, like most of the measures are like non-quantifiable. All right, so this is all with MA important topics. All right, so here like I had not included the bar graph chapter. All right, so the reason is that like we only had like 3 hours to complete the session, and it's all like it's already 3 hours. So like this bar graph like actually like don't have any weightage, like it have like less weightage like when compared to the other important chapters. So now all the important chapters had been covered, and the bar graph chapter can be like understood by like reading them. All right, so it's about some like line chart, pie chart and all. Okay, so you can get that by reading only. Okay, so just like revise that also. All right, so hope that all the chapters revised here is clear to you. Okay, so the next thing to do is that, like you had been like revised with all the chapters. I mean like most of the important chapters, like only this like bar graph is remaining actually. So I know that since MA is a on-demand paper, most of the students will be lazy to attend it so fast. Okay, so the thing is that don't waste time for that. All right, so once you had prepared for it, just write the exam. All right, so like I hope that like by the end of this marathon, like you will be like get like revised with the topic. Okay, so but now like what you should do is that revise the chapters again. Okay, just go through all the topics, and after that start to do the Kaplan and BPP kits, and also study hub. All right, perform the Kaplan BPP like and study hub like at least once. Okay, and after that attend the mock exam of the ACCA, and then main exam. So the main thing is the type that you are taking for it. I mean, after you are completing classes, soon after like when you start like preparing for it, then you will like remember like most of the thing that been like taught in the classes. All right, so by completing this also, I think like, I hope that like you have some like idea on like what like all of the chapters is. So just revise the chapters now. Okay, so since it's the like marathon session, like I can go to detail into all the concept. Okay, so like I just covered everything, and I know that. So just go through the topic again, and after that try to solve the questions. And as you know that like I'm in that group for like I'm in the group for F2, right? So just text me the doubt that you have. Text me the doubts. All right, text me the doubt that you have, and I can clear that. All right, and try to practice as much as questions as possible, and try to attend the mock exam. All right, and don't be too like delayed to attend the like knowledge level because it's on demand. All right, like try to attend it earlier so that like you can get into the like skill level purpose as soon as possible, right? So that's what I want to say about MA preparations. I hope you are doing well. All right, I hope like I think most of the students are from like ArivuPro only. All right, so try to solve the questions, ask any doubts. All right, so just send me the photo of the question and ask like what you have doubt on that. I can clear that. All right, so hope this marathon finds you well. Thank you.